111. 2. 3. Ja, läuft. Ja, jetzt hoffen wir mal, das bleibt. Ich höre ja mit, wenn was wäre.
Ja, hast du schon Ton? Hast du schon Ton oder nicht?
Das ist jetzt schon live, wir sind jetzt live.
Okay. Hector?
Ja, ja, nur das ist falsch schon. Ach
Test, test, test. Okay, if you want to start grabbing your seats, it's 2 minutes to 9. It probably hasn't started yet, but Achim is the technical guy. Okay, if you could grab a seat, please. Please come in, move away from the door so people can get in. Hey, Damon. Good to see you. Yeah. Glad you made it over. Well, thank you so much for coming. Yeah. Please grab a seat.
We're not going to have questions for the first thing, or are we?
Yeah, I'm going to make time for questions. I probably take them mostly from the room, but if you say there's one or two good, maybe try and catch my eye, and if you think you've got one or two good ones, then I can pose those as well.
Should just show up on the feed then. Okay.
Yeah, I guess so.
I'm going to get a microphone at some point then.
Okay. Wherever you want, that's totally fine, yeah. Okay, I think last year I was that side, so we mix things up.
Okay.
You see if people are getting in. Please grab a seat. We're going to start any moment now. Please come through. Welcome. Good to see you. Nice to see you, Eloise. Yeah, likewise. Yeah, good to see you. Hey, welcome.
How you doing?
Hey, good to see you, Kevin. Hey, so good you're here. Hey. Okay, there's still a few people coming in, but I think we'll get going. Outside and all the chairs look taken. Yeah. Well, here we go then. So, welcome everybody. It's so great that so many of you made it here to Engelberg. And ahead of the meeting, I was asked by some of you, when was the first Engelberg meeting? Well, I took the time to check it over the last yesterday. And the first meeting was actually in 2017. Which makes this the 9th meeting. So we did, though, miss 1 year with COVID, so I'm unsure whether next year will be the 10th anniversary or not, but we have a year to figure that out. I think it sounds like a good excuse for a party, so maybe next year we'll do a 10th anniversary, and then if there's any dissenting opinions, we can do another one on the 11th year as well. So it's so good to see so many faces here. Just looking around the room, I see people from Singapore, from Australia, from the USA, from Israel. And what I'm particularly happy about is I see a lot of people from China here. Again, our Chinese friends were missing during the COVID years, and it's great to see so many of you back here. I have on my left Will, the CEO of International Petroleum. Will, we'll get to you in a few moments. But I'm just going to start with a quick rundown of today's schedule. Tomorrow's schedule I'll announce tomorrow morning. We have 2 sessions this morning. The first one with Will and myself. Then I'm going to invite my partner Andreas up onto the stage. Andreas, are you here? There's Andreas. And then we're going to do your Q&A. That's going to wrap up at 12 o'clock. And then in the afternoon, there's the opportunity to go and discover Engelberg. It's snowed all night, and apparently the sun's going to come out later. So we've really been blessed by the weather gods this year. And there's 3 options. So we have a ski group for the skiers. And for many years now, we've had Nate Chesley as our resident powder hound. Nate, are you in the room? you want to quickly stand up so people can see your face? So if you're one of the skiers, Nate is your man. There is also a WhatsApp chat where all the information about the skiing is, or primarily to help people to connect with each other. And Nate told me he's also put a little sort of PDF in there explaining, where to meet, where the main points are. So check that out. If you're not yet in the WhatsApp chat, just maybe tap your neighbor on the shoulder, and I'm sure there's someone around who is. Many of you, of course, are non-skiers, but there's still an opportunity to enjoy the mountains. Andreas is going to lead a hike this year to the Bruni. So there's two actually cable cars in Engelberg. There's the Titlis, which is the one we've done in prior years. And this year, we're going to go up to the Bruni, which is a cable car on the other side. So, just to make sure you don't get confused with that, I believe Andreas is planning on starting the hike from about 12:45, so things will wind down here around midday, and then around 12:45, he's going to head up to the mountains with you. And then there's a third program point. There's a small minority of cross-country skiers, and my wife, Marion, this year is going to lead the cross-country skiers. So Marion, if you'd like to quickly stand up so people know who you are. So you could look for her if you want to do the cross-country skiing. Then one of the participants gave me a great idea a few days ago. Said one of the things they appreciated at other conferences were sort of breakout sessions. So in addition to the kind of the large group sessions we have here, the breakouts. Now, I know no one this afternoon wants to go and sit in a conference room and discuss whatever it is. So my idea is that we've got 5 or 6 people who've kindly offered to sort of lead these groups, but it'll be very informal. Some of them are walking, some of them are skiing, and if they are representing a topic that you're interested in, then just seek them out after we finish up here at 12 o'clock. So just to point out who they are. So we have Francis Mwangi. Francis, are you in the room? There he is. So Francis is an investor in Kenya who very kindly helped me organize my trip to East Africa earlier this year. He's come to Engelberg, for which I'm very grateful, and I'm particularly grateful for him helping me to organize my trip. Perhaps a quick round of applause there. So if you're interested in East Africa, Africa, emerging markets, he's your man. Then we also have Norman Rentrop here. A round of applause for Norman. I wrote about Norman in my half-year letter. He's been probably the single most important mentor for me in my investing career. A big thanks for that. He's also going to lead one of the breakouts. I believe he's in the hiking group. If you're interested in, he's helped many emerging managers over the years. He runs a single-family office. He's a successful businessman. All of these topics he's very happy to talk about. Then we have Ho, if you don't mind standing up briefly. Ho is a venture capitalist based in Silicon Valley, one of the most thoughtful I've come across, and also one of the most successful. Some of his investments include Roblox and Coupang, I think one of the earliest investors in Roblox, still one of the largest shareholders. And he's, I believe, a skier, but if you're into venture capital, then he's your man. We also have Will Thorndike here, the author of The Outsiders. Will, are you around? There's Will. I'm doing a fireside chat with him, or I should say a mountainside chat, because we don't have a fireside, but we do have a mountainside. So I'll be doing a mountainside chat with Will tomorrow, but I know he's a hero to many of you, and many of you have sent his book to CEOs, hoping that they capture some of that outsider magic. So he's here if you want to talk about capital allocation. I think he's the man for that. And then we also have Darryl Rawlings, the founder and then the chairman of Trupanion. If you're interested in pet insurance, Trupanion, or insurance more generally, Darryl will be in the hiking group today. And then finally, in addition to Will, we have 2 other representatives from International Petroleum here. There's Rebecca and Christoph, the CFO, and they're, in addition to Will, of course, also looking forward to telling you all about International Petroleum. which gets us to our mountainside chat, which I've been looking forward to for, well, I think since we first met. So, welcome.
Thanks very much, Rob, and it's an absolute pleasure to be here. Looks like an absolute great turnout overall, and look forward to getting in the guts of the discussion overall and explaining a little bit more about myself and IPCO.
Yeah, well, that's what we're here for. We're going to get to International Petroleum, the company you lead, shortly. But I wanted to start with you, and maybe you could describe where you grew up and perhaps some of the one or two formative experiences that led to you getting into the natural resources business.
Yeah, absolutely. So I'm born and raised in Vancouver, British Columbia. My family and my father, my mother, and I have a few other older brothers, 3 older brothers overall, and they moved from Dubai in 1989. And so my dad was actually working for the original International Petroleum Corporation at the time, which was headquartered in Dubai. At that period, he moved to Vancouver with the thought of going to a mining project and working in Vancouver for a couple years, and he ended up spending almost 20 years in Vancouver. I was born there as well as my brother. And overall, working in the natural resource space or growing an affinity to work in that space overall, it just came very natural to me. And so, while I was growing up, whether it be sitting in boardrooms at a very young age or going on family trips, my grandfather at a younger age and being around my father, they both had kind of larger than life type of kind of spirits within them that were very captivating, let's say, and lots of storytelling, and people would always want to be around them, and they seemed to always be talking about work, and it just came natural, the work element and the personal lives as well. So it just completely intertwined into one another, and that's as far back I can remember, and which is super important. I'm fortunate for myself to be working in an industry that I am in and have that desire and fire in the belly to be within it, because if you're not liking what you're doing, it's going to be very difficult to be successful in that field or space. And in terms of the early days, when my grandfather was around and he started with wildcat exploration, we didn't have a lot of money at the time when he was getting up and building his businesses. And so, the risk appetite might have been a little bit higher than it is today. And also, when he looked at Ian and Lucas, which were 2 of his 4 kids, his sons, he said, Luke, you're going to be in mining, Ian, you're going to be in oil and gas. And, they were kind of cast and they knew exactly what they were going to do, and they didn't have much of an option because we didn't really know many people at that time, or my grandfather didn't. And so it was important to, have those people and family members that you could trust and work into that space. And then growing up, through a generation, they have managed to have quite a lot of successes, discoveries, build vehicles, and, get a lot of professional expertise and people within the group overall. So that wasn't quite as big as a requirement in the early days as it was, as it is really now and for us growing up. And so my father didn't really push any of my brothers and I to go into the family industry, because he knew a lot of people and professionals and didn't want to make us do something that we didn't want to do. So I was thankful that I was really interested to do that, and I knew, petroleum engineering, whether it sounded cool or, just seeing that my grandfather and, my uncle had been doing that a lot, it made me interested to work in that field. And so from a very young age, I was, doing summer jobs in high school and through university. And after university, I ended up working as a field operator / field engineer in Onion Lake, which is an asset that actually happens to be in our portfolio today. It was under a different company at the time while I was working for them, under a company called Black Pearl Resources. And so, I finished my university. I did in the east coast of Canada. I was a mineral resource engineer. It had some petroleum engineering attributes within there. And then going to the field and just north of a place called Lloydminster at Saddles, Alberta and Saskatchewan, and working at a site in Saskatchewan called Onion Lake. That was quite a formidable kind of experience for myself, because I really got to get into the weeds of understanding about how operators' mindsets are at the field, how the communication works from the field to a regional office level in the company. And then also, like in the winter, it'd be minus 40 degrees Celsius, and you got to go out, you got to do your rounds, you got to check all your KPIs, and the plant shuts down in the middle of the night. You got to get back up and going. So that was pretty formidable experience in understanding that.
It's definitely a tough environment, minus 40 degrees, and I had the opportunity to speak with your former boss from that time, and I asked him obviously about you, and he said, I don't remember very much. He just got things done and kept his head down. And I mean, I think that speaks to your humility as a human being. So that's wonderful. You touched on your family a little bit. We want to concentrate the discussion on International Petroleum, but it's such an interesting story. Maybe you could just set the scene. Maybe some of the other businesses your family own and how they, and the role your grandfather played in starting those up.
Yeah, absolutely. So Lundin Group, today there's 12 publicly traded companies. They're all independent from one another. The common theme is that the Lundin family is typically the largest shareholder, and we'll also have either direct family members and or Lundin Group professionals that have been within the Lundin Group for a long time, making up the management and the board of directors. And so those two criteria are really what constitutes a Lundin Group company. And so today there's about 9 of these companies are mainly mining, and 3 of them are energy focused. So the mining companies, we're doing copper, doing gold. I mean, there's a little bit of nickel,
There's a really
silver.
exciting development in Argentina and Chile. Maybe
That's correct. Yeah, we
quickly.
have had a lot of vehicles in Argentina and Chile, and there's been a lot of business adventures through many decades and multiple generations within the family. And so today, company Lundin Mining, which is really the flagship mining company within the Lundin Group, has quite a few assets now in something that's called the Vicuña district, which is in the Andes and saddles the Chile and Argentina border there. And so there's significant copper, gold, silver discoveries that have been found, and they also have producing mines in Chile called Caserones as well as Candelaria. And so this is something we like to say is the future of really mining in general, because this is the most prolific undeveloped kind of area and mineral endowment in the world that hasn't been accessed yet. So super exciting area.
And of course, copper is absolutely essential for electrification, so playing a big role in the move towards clean energy.
Yeah, no, absolutely. And we're positioned quite well on that spectrum with respect to, copper. They say it's, the new oil. I think oil is going to be around for forever going forward still, but it's nice to be on both sides to get the exposure.
Yeah. So it's a mixed crowd here. We have some expert fund managers who I'm sure have read your annual report back to front multiple times, but we also have doctors, lawyers who perhaps don't know who International Petroleum is. So why don't you say a few words about who International Petroleum is?
Absolutely. So International Petroleum Corporation, we are a diversified upstream oil and gas company. We have about 500 people in the company, including contractors. Our headquarters are in Switzerland, and we have assets in Canada, Malaysia, and France. We're a publicly traded vehicle under the ticker symbol IPCO, trading on the NASDAQ Swedish Stock Exchange as well as the TSX. And so we're a company that was formed by way of spinning off the non-Norwegian assets from Lundin Energy back in 2017. So we started with just assets in France and Malaysia, and really were given the growth mandate to be the kind of international oil and gas vehicle within the Lundin Group. So essentially, some of these assets weren't maybe getting enough love and attention that we deserved, and not enough value being assigned to them from the market. And the growth in Norway was becoming quite significant with some major discoveries in Edvard Grieg and Johan Sverdrup. So, something that's a classic thing within the Lundin Group, which is, spinning off vehicles or acquiring new vehicles when maybe you're not getting value that you feel you deserved. And so the management team, board of directors, and really has followed through on that vision, and ended up doing multiple acquisitions in Canada to growing the portfolio today, where now we're around just under 50,000 BOEs per day in production, just shy of 500 million barrels in 2P reserves, over 1 billion barrels of contingent resources, and we have a net asset value right now of around $3 billion US, and we're about 1.5 billion USD market cap. We're in, a bit of a transition zone right now as a company, as we're building out a major organic growth project, which is really going to transform the company and take us to new heights. really strong balance sheet at this time with low leverage. We've been able to buy back our shares because we feel that we're very undervalued through our whole development project, which I'm sure I'll get into a little bit more detail as we continue the discussion.
There's so many strings I'd love to pull on there. Let me start though with, I think people would love to hear the Lundin Energy story and how that led to International Petroleum. Why don't you tell us about that?
Absolutely. No, it's a great story and a major value creation story there. And so if we take it all the way back, I touched on the original International Petroleum Corporation, which is a company founded by my grandfather. That vehicle ended up merging with a company called Sands Petroleum, and I believe it was the mid-1990s, around 1997, to form a company called Lundin Oil. And then Lundin Oil, their main asset was in Malaysia in a PM3 block. It ended up getting taken over by Talisman for just under $500 million, and it was around 5x in terms of the initial share price to the final share price, and crystallized good value there. After that transaction had taken place, still had a very talented management team, and said, let's do this again. So in 2001, Lundin Petroleum was formed, and there was one equity raise. It was the only one in the life of the company. It was for around $50 million at the time, and what they did is they grew through acquisitions. So they ended up doing a deal with it was a bank called actually Coprex at the time. They acquired some assets, one of them being in France that is actually in the IPC portfolio today, as well as they did another deal in a couple of years after, in around 2003, 2004 with DNO, and that's where they got a lot of acreage and access to a talented team in Norway, which ended up leading to some of the discoveries in the Norwegian continental shelf of the likes of Edvard Grieg and Jan Sverdrup that I'd mentioned previously. So this company grew from 3 SEK a share to over 400 SEK a share. There was an immense amount of value
100
created.
times almost.
Exactly. It was about 100x in terms of the value creation within this vehicle through time, and around 1.6 billion in dividends was thrown off through the vehicle in over 20 years. And it ended up being sold for, it was around $14 billion in total enterprise value. So it was a big, for cash and shares, to Aker BP in 2022. Yeah. So that was a huge deal for the family. Essentially, you saw phase one of Jan Sverdrup coming on stream, and there's a bit of a view that we're peaking production.
So Johan Sverdrup being
Jan Sverdrup is actually, it's an elephant discovery in Norway, and thanks for pointing that out. This field is doing around 750,000 barrels of oil per day, so it's one of the biggest producing oil fields in the world in Norway, and our team was responsible for really making that key discovery in the formation out there offshore. So very big deal, a ton of value creation, and on the back end of that company being sold, the Lundin family still has about 14.5% of shares in Aker BP, but it's not considered technically a Lundin Group company because BP and Aker are the biggest shareholders within the company. Of course, it's a very important financial position for the family. It throws off a lot of dividends and has a lot more growth projects coming on stream, which is quite exciting. And we do have the chairman of IPC also sits on the board of Aker BP, so it's an important company within the portfolio.
Yeah, and I should add, I announced it a few days ago that RV Capital is also invested in Aker BP now, so we're partners. We're not quite as big as you, but we're working on it.
Yeah, I saw that. Well timed. It's been quite a start to the year in terms of oil prices and overall equity prices for oil and gas names.
Yeah, it never ceases to amaze me how volatile the oil price is, but the companies as well. Intuitively, you would think people have an assumption on the oil price over the next decades, and they discount that and value the companies, but no. If the oil price goes up, the share prices go up, and if the oil price goes down, the share prices go down.
That's right. It's a very volatile industry, one that's supremely difficult to predict and anticipate, and obviously a huge market. And I think what's super important is that the way you run the company and a core philosophy within the Lundin Group, and especially with IPC, is keeping your costs as low as reasonably possible, keeping a strong balance sheet. If you have cash on hand, it can be helped to be flexible, because when there's a low point in the cycle, having capital availability to be able to either make acquisitions when assets are at suppressed prices, or just be able to weather the storm is super important. So that's where within our company, we have a lot of quick payback opportunities, and we could be spending much more money than we are spending, despite us already spending a lot on our Blackrod project. But you know, you got to have a prudent mindset when you're running a business.
We'll get to Blackrod
space.
for sure, but I think it's a great point you made. I think one of the things that frightens people, understandably, about oil and gas is the cyclicality. But when you have a great capital allocator that make sure they have cash at the bottom of the cycle and sells prudently at the top, then it can be your friend, the cyclicality. Absolutely, totally. And it really helps when you have a major shareholder that is there within the company. The Lundin family accounts for around 1/3 of the total shareholding within IPC, and so, you know, having that cornerstone shareholder and understanding that, you know, this is a long-term game, this isn't a short-term gain, and to have that backing behind us and understand that, you know, meaningful value creation doesn't happen overnight, and so having that support and being able to see that through and have the, you know, that you're going to make it through the cycles is really quite important. Yeah, and cyclicality or playing the cycle well is a great segue to my next question. Is, you know, in the same way, I think Lundin Oil started with very little and built it up over time to where you were able to sell for 100x. International Petroleum also started as a tiny company when it was spun off, and maybe you could describe some of the capital allocation moves you made to make it the company it is today. Yeah, absolutely. So, I mean, IPC, when we started life, we were, you know, just around $400 million market cap or just under that. And so we have had about a 4x since we've started life. And, you know, we're only doing 10,000 barrels per day. We had around 30 million 2P reserves. And so, as I'd mentioned, some of the metrics earlier, we were very small. But the fortunate piece is because we were spun out of Lundin Energy, we were born debt-free. We still had high-quality production, so we were able to leverage against our existing asset base and then do some meaningful acquisitions. So since the company is formed, we've done a total of 5 acquisitions, total consideration around $940 million USD in terms of the cumulative money that's been paid for these acquisitions. And as at the end of 2024, all of these assets have already paid back in free cash flow, which is huge, and you know, in excess of $2.5 billion of value has been created essentially through M&A. And what's super exciting as well, and one of the deals that we have done, out of the 5, one of them was funded using our paper. You know, we're all about your shares,
exactly through our shares. We're all about you know, our value per share growth. So when you have to issue paper, you have to look at something very, very closely because you don't want to dilute your shareholders down very much. But essentially, you know, the company that we took over, which was the Black Pearl Resources company, the one that I'd mentioned I was working for in my earlier years, was trading at a much more significant discount from a 2P net asset value perspective relative to IPC. So we bought into that discount. We issued around 80 million shares at that point in time, and you know, that's been a huge part of our organic growth story going forward because they had a lot of producing assets, but they had a lot of contingent resources as well, namely at this Blackrod asset. And so now we're exploiting that. There was no value assigned to that in the deal, and through all the buyback programs that we've been doing, there's only been 5% dilution just from the shares outstanding. All of our acquisitions have been quite accretive, but from a shareholding perspective or shares outstanding, there's really been minimal amount of shares issued or net shares outstanding as we stand today, and we're going to continue buying back our shares provided our share price stays suppressed.
By my calculation, some point in 2025, your share count is going to be back to where it was when you were listed, and the company is so much bigger. So,
exactly, it's getting close.
Congratulations for that. So you've mentioned Blackrod a couple of times. You've also used the concept contingent resource. Why don't you explain what a contingent resource is, and then let's move on to Blackrod.
Absolutely. So in terms of contingent resource, essentially it's a lower classification than 2P reserves. It means that you need to make ultimately a commercial decision. It's got to be economically viable in order to book those contingent resources into reserves, and you got to have a development plan to exploit those essentially. And so those 2P reserves, they're in your development plan. They're either already producing or to be developed, and you have a firm plan to go out and mature those resources. And so when we sanctioned the Blackrod project in early 2023, and before even getting there, that asset has 1.3 billion barrels of recoverable resource, which is a significant amount to call a field that's greater than 1 billion barrels an elephant field. So it's very, very big. The phase 1 development, when we sanctioned that in early 2023, just matured around 220 million barrels out of that 1.3 billion barrels into 2P reserves. So with that, we brought that into our net asset value, which at the time in early 2023 represented around 800 million USD in NPV 10. And so not a single dollar of value is assigned in those, other billion barrels of contingent resources at Blackrod. So if you invest in IPC, sure, you're getting, there's around $3 billion in net asset value, but then there's a lot of value that's not taken into account in any of our corporate cash flows or our net asset value calculations from the contingent resources. So very much an upside component within the portfolio, and which will be exploited through future phase expansions at our Blackrod asset, where we have approval to go to 80,000 barrel per day, regulatory approval, and we're starting with a bite-sized development approach going to 30,000 barrels per day, which we expect first oil to come in 2026, and we're about 2/3 of the total spend there as at the end of last year.
Yeah, I think it's been probably a little bit of an overhang for the stock, this huge project you have, but you're slowly, we have line of sight to first steam, so that looks to be on good track.
Absolutely right, and we've seen it time and time again, whether it was again through these Edvard Griegs or Jan Sverdrup developments, or even if we look on the mining side, in Lundin Gold, in Ecuador, there's a big gold mine that the Lundin family has a controlling position in this vehicle, and it's called the Fruta del Norte asset. And this project, which was something that was a distant site to be developed, it ended up being acquired for around $240 million through Lundin Gold. Of course, we're the major shareholder at the time there. And going through the development period, the stock might have been around $4 a share, and once it starts coming online, it goes multiple higher. And today, it's really a world-class gold mine, and it's the stock's around $30-$35 a share Canadian. So there's been a lot of value created, and again, it comes to that that long-term approach and having the right people around you, and understanding obviously the guts and the asset quality that you have in front of you, and then making those kind of bold contrarian moves. Say, well, if no one's developing, I think we should develop this if it's more cost effective and bigger value can be created through that rather than acquiring producing assets.
Yeah, I mean, I think the capital markets today are quite skeptical about oil companies which are reinvesting. The market values them primarily on free cash flow, and which of course encourages companies to invest less, and you're going down a completely different route.
Totally, yeah. You can see, I feel like especially in Canada as well, it can be a bit short-sighted in terms of how, target prices are considered, which usually, looking at a short-term cash flow multiple. And so if that's how you're evaluating IPC and you're looking at a 2024 or 2025 cash flow multiple or free cash flow numbers, you're missing the entire story, because our cash flow is going to be twice as high as it is relative to 2024 in a few years' time. So if you're able to look past that and have that patience, should be rewarded on the back end of that.
Yeah, and so it's incredible because how quickly time flies. But this Blackrod project has been a huge investment for you, but we're getting pretty close to the point where the company is going to be producing enormous or prodigious amounts of free cash flow. What are your plans for that?
Yeah, it's a great question. We're looking forward to that, and it's a multi-year build, so it's around 3 to 4 years, and being as closer as we are, where we actually were just there with the board of directors before Christmas. We had a site visit to the asset, so a ton of packaged equipment, and the facilities are being erected. All the teams gave us a thorough walkthrough. All the drilling's going very well, and construction activities. To really see it live in person is super exciting. And so we sit well positioned to be able to deliver this project on time and on budget at this time. And there hasn't been a true greenfield development since around 2017 in Alberta. So it's a big move, and provided everything's delivered on time, I think it'd be really good. And the follow-up question you had there,
yeah,
sorry.
What's next?
What's next? Yes, what's next? So I mean, in the next 5 years, or between 24 and 2028, we expect to generate between $900 million in free cash flow at $75 Brent. to $1.8 billion in free cash flow at $95 Brent. And so, and we look at the next 5 years after that, through 2029 through to 2033, we look to generate between $1.75 to $2.8 billion in free cash flow between $75 and $95 Brent. And so,
which is more than your current market cap.
which is much more than our current market cap, exactly. So when we're going to be flushed with cash, it's going to put us in a great position to, really have the optionality to have, enlarged shareholder returns, be able to have a bit of a war chest and have extra flexibility to either grow through M&A or also look to build out future phase expansions at Blackrod. So, we have a really good portfolio with a tremendous amount of value that can be created. Ultimately, we do look to grow beyond our existing portfolio, but we're going to be very disciplined in terms of how we approach that. And so, when we're looking at growing through acquisitions, we've got to look at buying back our own stock or developing our own projects. How does it compete with that to take it to the next level? So a lot of optionality within the portfolio, and upon Blackrod coming on stream, I think it'll put us in a new position to be able to grow the company and take it to new heights once again.
Yeah. How do you think about share buybacks?
Share buybacks, we try and keep it quite simple, to be honest. We measure our intrinsic value based on our 2P reserves, which arguably could be a bit conservative given all the contingent resources that I had mentioned earlier. And so provided we're not trading at our net asset value, and we're around $1.5 billion market cap right now, so really we're buying our stock back for 50 cents on the dollar. So with the family being around a 33% shareholder, and of course, all shareholders, it's nice to get cash back. However, an understanding that the value that can be created through buybacks and buying your stock back for 50 cents on the dollar versus $1 going out the door towards dividends, the value that can be created is much more significant through the buybacks in that form. So, ultimately, we would like to harvest cash flow out of this entity through dividends to the shareholders. But given the resource that we have in the portfolio makeup, it's very long life assets that we have. So we have a 27-year reserves life index, which means we could essentially keep our production flat for 27 years just based on our 2P reserves. Again, nothing considered in our contingent resources. So having that longevity, flat production profiles, long recovery factors is really attributable to this heavy oil that we have. And it also allows us to be able to say, okay, well, let's keep buying back if we're not fairly valued, and we can do that for multiple years, and ideally we will compress that discount, and then at that point in time, when we're trading at a premium, we'll look to hit the dividend button. But if we don't ever get there, we'll virtually go stealth private through our continuous buyback program. So.
Yeah. We love to see buybacks. Dividends are great, but the problem is we pay tax on them, and then so every dollar the company distributes, maybe 70 cents arrive with us. Whereas when you buy back stock, there's no sort of tax leakage, and on top of that, if you're buying it below intrinsic value, you're actually getting more than $1 for every dollar you return.
Yeah, that's absolutely right, and especially no capital gains tax in Switzerland is ideal as well.
Yeah, maybe you can encourage your friends at Aker BP to go down that route as well.
Yeah, I could tell you some people are pushing for that. Yeah.
So I think there was some surprise when people saw an oil company show up in my portfolio. I've always been super focused on family-run businesses, so for me, IPCO is a perfect investment, but there was nevertheless some surprise. And I think that was probably connected to being oil, to it being an oil company, and especially maybe the younger generation. If I see my daughters concerned, understandably, about climate change, which we all know exists and is a terrible thing. But we also need oil. Maybe you can speak to that.
Yeah, absolutely. It's an industry that's been under a lot of duress, let's say, and not necessarily the flavor of the day from an investment perspective, given a lot of the scrutiny that it's received, especially pre-COVID period. And a lot of that, I believe, is a little bit unfounded. I think there's a lot of scrutiny on the emissions side of things, but there's a lot of technological innovations that will continue to progress through time to make operations more efficient and less emissions intensive. And once COVID took place, and of course the tragic war that unraveled in front of us, energy security became a bigger theme. And we're also, generally seeing a pendulum shift a little bit from more of a socialist view from major the global economy, I'd say in general, now going back to maybe a little bit of a different view. And so when I think of oil and gas going forward, and oil specifically, demand continues to grow every year here. And so, with demand growing and with population growth coming from emerging markets, developing nations, and societies that maybe haven't had, some of the economic prosperity, dense forms of reliable energy are extremely important to be able to take that next step. And so, whilst the world is a very complex place and there's different stages of growth, depending if you're in the Western world or in other areas, but ultimately the biggest cities forecasted in 2100, some of the names you don't even really recognize because they're coming from different places in Africa and Middle East and in Asia. And so, with respect to that, we see demand growth being strong coming from those places. There might be a little bit of demand weakness coming from the Western world, but overall, the major rating agencies anticipate demand to continue to grow for the foreseeable future. And there's not a new shale revolution discovery happening in the U.S. overall. So, we've seen some growth coming from the U.S., but it is general consensus that it looks to be overall plateauing. And then, with that shaping up, where's a lot of the supply going to be coming from? There's been a lot of lack of investment in prior years as well. So, we believe that this shapes up to be a great space overall to continue to invest in because it's not a replaceable source at this point in time. And so I think people are starting to understand that you can't flip a switch to do the energy transition and switch to an alternative source. It's also because oil has so many different byproducts coming from it. And if you think about gas, you think about this AI boom, this technology boom. Where is this all? It all requires tremendous amounts of energy, right? In order to build out grids and to get power supply, in order to go through all these technological advancements and go through machine learning, you need a lot of energy. And so I think the overall oil and gas base is going to be re-rated in time, is my personal belief. It makes up around 10% of the earnings in the S&P 500, yet is trading at half of that level. And overall, you can do it in a socially responsible way. And I think there can be continuous improvements in the industry through time to become less emissions intensive.
Yeah. I mean, it's a great point that the world needs it. And when I was in East Africa with Francis, we went to Uganda, and Uganda's had a big oil find, I think close to the border with the DRC. And 8 agencies won't let them develop it. But of course, people have motor cars there, and so they end up having to export it and then import the stuff from elsewhere. It's incredibly inefficient.
Yeah, another country like that, which has been unfortunate, Canada, is similar in terms of they haven't really done a great job from a federal government standpoint to really truly unlock the resource potential. And it's one of the most highly regulated, ethically sourced, and cheapest energy sources that exists in the world from oil and gas, but also in the mining front. And there's been a bit too much regulation constraining that. And so, Canada produces around 5 to 6 million barrels of oil per day, and we sell a lot of this crude to the States because it's largely landlocked, and then we buy a lot of the refined products coming back. So, there's a lot further potential, I think, to go in Canada, and we're seeing a government switch there that's likely to come. The election is in October of 2025, where the Conservatives are leading that. So I think that's a great thing for the industry overall, and also for IPC. It's coming on at a perfect time where we're fortunate there has been an extra pipeline that's come on stream to take away extra capacity called the TMX pipeline, which is adding 590,000 barrels per day of extra egress capacity within the Western Canadian Sedimentary Basin. And so tightening differentials are happening. We're having a shift in government, which should be more pro-industry. And this is all happening when our major growth project is about to come online. So it's perfect timing.
Yeah. There's been 1 or 2 political changes south of the border in Canada. Any thoughts on that?
Yeah, no, that's definitely an interesting one, and I am on my Twitter and X account, so I think we got to be braced for a lot of tweets coming from Trump in the coming 4 years, which should be quite interesting, and he's going to have quite an impact overall. I mean, there have been things like tariffs that have been mentioned that he's going to be intending to put on place. It's also been a mention that it would be a sign to Canadian oil in terms of the imports coming in. I'd be personally surprised if he carries through with that, because I don't think that would be a net positive for either party. It ultimately would mean they'd have to pay more for the oil coming in, so they'd either have to push that on to the consumer through increasing the price in the product, or find another means in terms of trying to maintain their margins, or ultimately eat into the refining margins overall. But I think it's going to be an interesting time. I think on the positive, hopefully it can help and support to get a resolution with the war that's going on in Ukraine and also in the Middle East. And I think overall in the short term, as it relates to oil and gas prices, there's a bit more of a skew to the upside, given some of the sanctions that are intended to be enforced in the likes of Iran, also in Venezuela, and then now we've seen in Russia as well that's going to happen. So I think in the short term there could be a skew to the upside, and we've kind of been seeing that as well in the recent price swing since the start of this year.
I think I'm going to ask one more question and give the audience the opportunity to ask a few questions. But, I've had the privilege to meet many of the executives at International Petroleum, including Rebecca and Christoph, who are here today, but also several of the executives at some of the other Lundin Group companies, at some of the copper businesses and the diamond, the gold. And they all seem to be very much cut from the same cloth, very much no-nonsense, non-political, roll up your sleeves, get things done type of people. How do you do that?
Yeah, it's a great question. We're super fortunate to be surrounded with such good people. I mean, especially myself and the company. You've mentioned Christoph and Rebecca, and I mean the wider team that I have around me. There's no I in team, so it's all about the people and really empowering the people to take those forward. A classic, statement is you could have a great asset and a poor management team, and not create a lot of value and actually destroy value, or you can have a decent asset and a great team and create a lot of value. And so, what it comes down to is, skin in the game is obviously important, proper incentivization, but also fostering a culture of togetherness and knowing that we're in this in the long term and not looking to be super bureaucratic and bogged down with processes. I think those are some of the key ingredients that make it an environment where people want to stay in and stay within the Lundin Group. And so we're super fortunate to have been surrounded with such good people and to be able to retain those people. And, that's going to be a core focus to have going forward, because we can't do it without the team.
Yeah, I mean, the people I met all were like super keen to have, small salaries, but as much stock in the companies as they could possibly have. And, I think it speaks to the belief they have in the business, and that's worked out very well. Many of them have been with you for decades, and they've become wealthy alongside your family, and that's the best possible way to take people with you if everyone's being successful together. Yeah,
absolutely, and it's been quite a change. In the early days, we didn't really have the capital markets or the reputation to be able to finance projects forward, bring them through to development and into operations, and as you would make a discovery, and we'd want to do those things, but we really wouldn't have the kind of business acumen, if you will, and the size of a team and company to be able to do that. So there's been kind of a big growth shift where we've grown these companies, grown the people within them, and be able to take things to the next level. And of course, having some successes along the way makes people that much more fired up as well going forward.
Awesome. Okay, so if my daughters are around, maybe they wouldn't mind coming forward to grab the mics. Is Amelie and Ollie there? Oh, and we've even got Tommy as well. Tommy, why don't you come and help out? round of applause for Tommy and Ollie. I think they're just there. I hope the mic's alive. If not, I can give you my one. You better keep yours, because I think probably two. So who'd like to ask the first question? Thank you so much for doing that.
So thank you for being here, and it was very interesting to listen to you speaking about your business and the origin from your family. And My question is, so I think the investment case is very compelling for what you said, half the net asset value and probably market cap equal to the free cash flow generated in a few years ahead with low long-term debt. So I'm curious about how you think about downside when you make acquisitions and when you look at your business in a general way. So on a balance sheet level, on an income statement level, so your free cash flow is going to be produced also depending on the price of oil. But then you also know that if the oil price goes down, some suppliers are going to go out of business or not produce as much. So there is some protection there. So for us investors and not experts in the business, how would you help us think about downside risk in your business?
Yeah, it's a great question, and number one answer to risk, I guess, being in the space is going to be commodity price. That's something, of course, we can't control. It's very unpredictable.
Didn't catch it. What type of risk?
Commodity price. Commodity price
yeah.
risk. Yeah, exactly. So oil prices in general or gas prices, and so one thing that helps in knowing that if you're looking to do an acquisition, of course, we're running a range of sensitivities, down price sensitivities or higher price sensitivities to see how robust that opportunity is under varying pricing levels, and so like that's got to be the number one biggest risk. And so what you want to do when you're managing the business, of course, is have a setup where ideally you're an operator of your assets as well. So operating your assets mean you can really dictate your destiny. And so if prices are changing on you, having the ability to pull the lever to ramp down activity or ramp back up quickly if prices move so you can capture those good prices is a key attribute, but you don't always get that luxury in terms of being the operator of the assets. Fortunately, within IPC, we're the operator of pretty much all the assets that we have within the portfolio. And so those are some key components, I would say.
Great question. Thanks for that. Next one's over there, Ben.
Hi, how are you? I have a question about natural gas prices in Canada and your thoughts on natural gas market in Canada and also its role for IPCO in the coming years, because you're both a producer. It's an output, but it's also an input. It's hard for me to understand why, the prices are so low, and what if you could talk about the economics for the marginal producer? Thank you.
Yeah, another great question. And so natural gas prices in Canada have been very, very suppressed. I mean, right now, winter season, you do see gas prices go up a little bit. It's around $2 Canadian per GJ, and in the States, you're looking at around $4 or so NYMEX per MMBTU. In Europe, or you're looking at gas prices that are double that or in excess of that. So there's a huge arbitrage win that you can do if you're able to get access to Canada, and leading into that is the Shell LNG project, the LNG Canada project on the west coast of British Columbia, which is supposed to add around 2 BCF of extra demand. And so there's an anticipation for that project to be starting up and online and getting LNG out by 2024, and that hasn't happened, and so it's slipped to the right a little bit in terms of the schedule overall, and we should see positive signs coming in 2025 to help improve the overall conditions there. But as a result of producers ramping up their production and also a little bit more moderate winters the last 2 years, this has led to bloated storage levels well below the 5-year average, which again has corresponded to lower prices overall. So we're cautiously optimistic looking forward to the back half of 2025, largely in line with the forward curve, and also looking beyond that in the more longer term. There's a big announcement out of Alberta around data centers where they want to spend a significant amount, I believe $10 billion or so, on data centers. And so this is some of the cheapest gas that's around. It's a very environmentally responsible jurisdiction, heavily regulated, so it makes a ton of sense to be able to do that. So that should be more constructive and positive for a longer term outlook in Canadian gas in general for benchmark pricing. As it relates to IPC, so about 1/3 of our mix, production mix, is natural gas weighted, coming from our Suffield asset in southeast Alberta. As you rightly noted, we are net long gas, meaning that we sell more than we produce. We'll be going into more of a balanced position come 2030 to eventually a net short position. It's a nice to have when you're physically hedged as such, but it's not as big of a component or a concern. We're not as sensitive to gas prices overall. Now, if we're able to acquire another asset and push that vertical hedge out for more years, that would be fantastic, but we tend to be a bit more of a focused on oil type of company.
Norman, at the front here. Yeah, why don't you take my...
Well, thank you very much. And as value investors, we are always concerned about who are the competitors and what is your long-term defendable competitive advantage. So what do you do better than the others? Are you more audacious or better in operations? So could you give us some color on that kindly?
Yeah, no, it's a great question, and it can be a bit of a needle in a haystack when you're looking to invest in a company in the oil and gas space because there are so many. But I think there aren't so many that have an owner-operator mentality where you have a cornerstone shareholder that represents in excess of 20% of your stock that really is aligned with your management team and pushing that forward, that can allow the company to pursue longer-term value creation developments like what we're doing in the Blackrod project versus seeking short-term gains or just focusing on free cash flow or dividends and coming right back to the shareholders. And so by having that and also having your management team invested as such in a way that they're not just looking to collect a salary. We're here for this and have a lot of skin in the game in terms of equity exposure. I think that's one of the attributes. Competitors, you're going to be looking at, this is a junior space or to intermediate space based on our size of a company. So, there's a lot of competitors out there, whether it be European side or Canadian and oil and gas side. But, when you look at the track record of delivery, what's really important as a publicly traded company is what you say you're going to do, you go out and do it. And so we are, consistently delivering within guidance, whether it be on production or costs or cash flow forecasts year in, year out. So a level of credibility is very important. And then having that, significant resource life in front of you is something that some Canadian peers have, but you don't really see this production growth coming from Canadian oil sands peers relative to the size of company that we are. So, we are deliberately investing in buybacks as well as a growth project at Blackrod. Therefore, some of our production is naturally declining, but our production decline is very low at less than 10%. And so when we look at the forward production growing to in excess of 65,000 barrels of oil equivalent per day, if we assume roughly a 10% decline rate from 24 to 25, our 25 production going to 27 production, we're talking at an excess of 55% in production growth, which is quite significant. So you're not going to find too many companies that have those attributes in the peer group.
Yeah, very good. Yeah, and can you expand on the family aspect?
On the family aspect, in what sense? Sorry?
Yeah, you said, you're owner-operators. Your grandfather started, if I get it correctly.
Yes.
Okay, so your father and then you and is it your brothers or,
Yep.
or your cousins?
Exact brothers.
Okay, and how are you operating together? Some families from Uruguay to Finland, fourth generation, some 2 kilometers around the Zurich church. So different families, different approaches. What is your approach?
Yeah, no, it's and thanks for elaborating on that question. And a famous saying is, by the time you go to the third generation, that's when the wealth can be destroyed in a family-related industry. And we're all extremely competitive individuals, and that's just added fuel to the fire overall. And hasn't really been by design, but fortunately we're spread out in such a way where my brothers and I are focused focused on different companies. So there's some overlap, and then there's, consistent meetings happening throughout the year to make sure everyone understands what's going on. So essentially, energy hub located in Geneva, where, I'm predominantly focused on. Of course, IPC is my number one priority. I'm also on boards of Shammer and Petroleum, as well as Oren Energy. And then the mining companies, the headquarters are based in Vancouver. So a couple of my brothers over there managing the mining companies more so. And so, when you have that kind of cornerstone shareholder and family that understands the guts of how this industry works and how arduous and challenging it can be, and have that long-term vision, it makes us, let's say, a bit more sympathetic relative to maybe other types of shareholders out there in companies. But overall, we're always striving for continuous improvement. We're always challenging, why aren't we doing this? Why aren't we doing that? And, seeking and holding people to a very high standard to try and, maximize the value creation for all our shareholders.
Thank you very much.
Yeah, I had the privilege to meet 3 of the 4 brothers. The fourth missed lunch because he was closing a $5 billion deal with BHP. So I guess he gets a pass. But I hope we can do. But they're all equally driven. It's really quite incredible given the success of the family. So we've got about just a couple of minutes left. So I'll take one more from the room. Is Nick Chisco here? Do you have any from? Should we take an online? Okay, so let's get to one more. Dan, why don't you have one, and maybe we'll try to get one more after this. Maybe if you could keep your.
Thanks, Rob. I suppose there are capital allocators that have good outcomes, and there are capital allocators that have poor outcomes. And you said you're operating in an industry that's incredibly unpredictable. It's very volatile. So among the universe of capital allocators that have had good outcomes, how do you distinguish between those that are lucky and those who are good capital allocators that are going to be able to sustain good capital allocation into the future?
It's a great question, and of course, we all have the vision to create this huge amount of value and allocate capital accordingly. And we're fortunate to have different vehicles that have done similar things in the past and be able to kind of follow that. But every single company, every asset, all people are different than one another. So you got to really create a plan and a capital allocations plan that's specific to your company. And so for us, trying to maintain a strong balance sheet is super important because of the unpredictability in overall prices. When you have major capital expenditure or debt maturities coming up, we might be a little bit more defensive and look to hedge benchmark prices. Traditionally we do like to give our investors exposure to higher prices, but we have to think differently when we're spending a lot of money or debt maturities are coming up. So I think just managing your portfolio accordingly, keeping a strong balance sheet, and then understanding what you have in your portfolio in terms of your cash flow generation and the long-term profiles that come with that.
So we'll take one last question. I see about 15, maybe even 20 hands go up. I've been biased towards the front, so maybe we take one from the back, towards the back. Ollie, you've got one? Perfect. And then we'll close after that. But, Will and his team are here the whole weekend, so there'll be plenty of opportunities to ask your questions.
Hey, Will, thanks for making the time. Just wanted to see if you could elaborate a little bit on the hedging front. I mean, obviously you all share details in your quarterly reports and everything, but just your general philosophy on that and when it's right to kind of protect your downside versus give investors more exposure to the commodity.
Yeah, thanks for that. And, it's something we traditionally aren't big on hedging, like to give all our investors exposure to the commodity prices. But, when we're in a situation where we're spending a lot of capital, we're growing a net debt position, or there's a major debt maturities coming up, those are the type of conditions where we open up and we're a little bit more, open to hedging essentially. But also what comes into that, of course, we're monitoring the macro conditions every single day. And it is difficult to form a view. When we think about what's going on right now in the world as it relates to oil prices, we believe we're range bound. Okay, and so OPEC, they're claiming there's around 5 million barrels per day of spare capacity on the sidelines. I personally think it's a little bit less than that, but nevertheless, if prices go on a tear, it's going to be tough for that alliance to keep those barrels on the sidelines. And so therefore, if we hit triple-digit oil prices in the short term, sure, it might hit there briefly, but then I would imagine barrels would come back onto the market as such to suppress higher prices, and similarly lower prices if those are to come. I think OPEC is going to have a big part in trying to play that in order to manage their budgets. They want to see healthy oil prices as well. So, we don't have a specific hedging policy that forces us to hedge in place, which is nice to have. It allows us to be opportunistic. So when we form a view and we want to hedge, whether it be differentials, currency, commodity price, we're able to get a hold of our audit committee quite quickly. Of course, we'll form our view, we'll get maybe expert opinions in as well, and then go and lock it in. But we try not to do too long-term of hedges, just typically one year out at a time.
Fantastic. So, Will, thank you so much.
Thanks so much, Rob.
Okay, so we're going to break now for 30 minutes, and it'd be great to see you all back here at 10:30 for the Q&A with me and Andreas. So it's 10:30. If you want to grab your seats as quickly as you can, please come through. Andreas is in the house. Hi. I made it for my, I already drank from my, I got a bit of a I don't know which are which. Yeah, please grab a seat. So please come through. We want to restart. Hey, Robert, good to see you. Yeah, I should have forgot about it, yeah. Please come through. We want to restart. Jason. Okay, we're gonna start pretty soon now. Hey Tim, so good to see you. Yeah, thanks for agreeing to do the panel tomorrow.
Wait, what? I agreed to do a panel?
Did I not? Did I? Oh my God, I'm so bad. Okay, we speak afterwards.
Is this the China Investment?
Yeah.
No. I get. We were wondering who's doing it because we're all discussing.
Picture kind of like.
Let's talk. Jackie, did you hear Rob? I'm not speaking.
Okay, I think we'll get started. People are... Oh. Andreas, does your
Hi, Rebecca. Nice to meet you. I'm Olivia. Amelie, nice to meet you. Are you from Engelberg? Yeah.
Okay, just let the last few stragglers come in. Okay, I think we'll restart the session. I forgot to mention at the beginning that we have a buffet to your right with some of the best donuts I've tasted outside of North America. So if you haven't been to the buffet yet, I would certainly encourage you to go there. So we're coming now to my favorite part of the event, which is when I get to answer your questions. Many of you have been here before. You know the format. You can ask anything you want, whether it's investing related or how Andreas and I think about investing, the companies are investing, or for that matter, anything else. The floor is yours. So we have 3 microphones in circulation. If you'd like to pose a question, please just raise your hand. But please also raise your hand while we're responding so we can get the microphone in place for the next question so we don't lose too much time. Great. So who would like... Paolo, you already have the microphone, so you can kick us off.
Thank you, Rob. Thank you for organizing this meeting. Every year, more people, and every year, more successful. Congratulations.
Thank you, Paolo.
Just a quick question about an update on credit acceptance. What can you tell us about credit acceptance?
Just an update? Or, yeah, so Credit Acceptance is a company we've owned for probably around about 10 years. It's a company we love. We love the owner operator managers there. For those of you less familiar with it, they provide subprime loans for automobiles in the US. And what makes them very unique is that they guarantee acceptance. So anyone can go in there and get a loan. And you'd ask yourself, well, how on earth can that work? And they've developed a system, a big part of which is aligning the incentives of the dealer with the customer, which allows them to do that. And it's really a wonderful business, which has done very well for us over a long period of time. If I look at the last 5 years, there's been a very odd sort of period with lots of unusual things happening. So they had an incredible boom during COVID, where thanks to stimulus checks, people staying at home, not being able to go out and spend money, the performance of the loans was way, way better than they could have ever possibly imagined. They had extraordinary profits then. And then in 2022, we had this huge spike in interest rates, in the prices of cars. And that cohort of loans has performed very badly as people have been less able to repay their loans. We're now entering more of a sort of a normalized period, and I think it will manifest very soon that especially the 2022 cohort is becoming less and less important over time as people pay it down, and the 2023, the 2024, and soon to be 2025 cohorts become much more important. So, in the same way I made a prediction last year that Carvana would have an exceptional year this year, I think it's pretty clear that credit acceptance is going to have a pretty exceptional this year from an earnings perspective. What that does to the share price is anybody's guess, but we're long-term fundamental investors, so if we see the companies doing well from an earnings perspective, that makes us happy. One also footnote, the 2022 was by far the worst year they ever had in terms of the loans originated. But importantly, not only were those loans profitable, they also own their cost of capital. So it shows you just how an exceptional business this is, despite everything that happened, that those loans performed less well than they hoped, but they were still pretty decent loans.
I'm not so familiar with credit acceptance, not because it's bad business or there's anything wrong with it. I've just not looked so much into financial businesses.
So who would like to ask the next question? Does anyone have a mic, or maybe you can raise your hand?
Kann ich anfangen?
You have it, great.
Yeah, okay. We heard in the last, let's say, weeks that the new president in America wanted to have the Panama Canal,
was there an
wanted
election?
to have Canada, wanted to have Greenland, and I think it will go on. How is your reaction on it?
Well, well, people sitting where I am are well advised not to be.
I don't ask for how can you prepare, but I ask what do you expect and how can we react?
Yeah. Well, people sitting in my seat are well advised not to be political, so I'll choose my words carefully. But I think President Trump is clearly an iconoclast. He breaks with a lot of norms, and that attracts people who like him, and it also divides opinions in the other direction as well. But it'll be super interesting from the perspective of a citizen of the world. It'll be interesting to see what happens. Clearly, he's going to change a lot of things. I hope for the US, but also for the rest of the world, that those changes are for the best. But ultimately, I don't have a strong opinion on how that will play out. The way I think of the world, and I'm sure that won't be a surprise to many of you here in the room, is that we focus on finding great businesses that can thrive irrespective of who the president is and what the policy is that he or she enacts. And that's what we'll continue to do, and we're trying not to pay too much attention to the political world.
Yeah, I think none of our business is going to be dramatically affected by whatever policies that are put in place. And Donald Trump has also a tactic of negotiating deals. So he comes out with a very high demand, and then to get people to negotiate. And I don't know what he will negotiate with Canada or with Greenland or with Panama. We'll see.
will certainly be interesting.
Hi, Rob. Chandan.
Chandan, hi.
Yeah, thanks for inviting me. And yeah, it's great to see the meeting being successful every year. So, Aker BP versus IPCO, like why do you decide to do both? Like what are the pros and cons you see in either companies? And yeah, just tell us why you decided to add rather than more into IPCO than like buy a new position. Thanks.
Yeah, so what often happens, for a long time I worked on my own, and obviously since Andreas is here, we're now two of us, but the way we both approach investing is to dive really deep into companies and sectors before we invest in them. And so that means not just studying the company you're potentially interested in investing in, but also the kind of the suppliers, the customers, the competitors. And it was really as part of that journey that I came across Aker BP. Will was kind enough to connect me with Ash, who is the chairman of IPCO, but also a board member of Aker BP. And it was through him that I learned about Aker BP, but it was also through him that I learned that although intuitively Aker BP sounds like it could be quite a sort of corporate sort of, big sort of conglomerate type of a business, but I learned it's incredibly entrepreneurially run. I met with the CEO of Aker BP a few months ago, and he told me that when the business started out, he sat down with Mr. Rocker, who's actually the largest shareholder in Aker, and they sort of started with a blank piece of paper along the lines of, okay, what would the ideal company look like? What is all the bullshit we wouldn't want to do, which we see at other companies? So it has an incredibly entrepreneurial culture. It has great shareholders, including the Lundin family. So it was something which I thought would be a great additional company to have in the portfolio. In terms of why there's two as opposed to one, I think it's a sector I'm reasonably new to. So I'm quite happy to sort of diversify the bets a little bit. I think Aker BP is a very different sort of animal to International Petroleum. International Petroleum has this very young, enthusiastic team with huge ambitions, huge growth ahead of it, which I'm sure they realize. Aker BP is more of it's also a growing business, but not nearly as fast. But it pays, I think, 12 or 13% dividend yield. So it has, a very much a different sort of, I would say, risk perspective and short, capital return perspective. So it seemed to me like a great sort of addition to the sector.
I would add that also in terms of the asset, there is a totally different risk profile. Like IPC is developing oil sands in Canada, where Aker BP is developing offshore oil in Norway, which is a much lower cost location and a much lower cost asset, so it's less dependent on the oil price, and so it's a different set of outcomes. And I personally have never been opposed to owning two companies if they are good ones in a sector. Like I've owned Microsoft and Google and Apple, which are competitors in the same industry kind of for many years, and I never viewed it as a contradiction.
Yes.
Rob, I wanted to get your opinion on Paycom. What do you think about the business in terms of there are a lot of competitors? It's a relatively low barrier to entry business, but high switching costs. So what do you think about Paycom, and any updates on Pinduoduo from the last time you posted an audio note on your website about it?
Yeah, so I'll let Andreas answer that because Paycom is a position that he owns through his accounts. But maybe just to provide some context for everybody, so we file a 13F every quarter, as we're obliged to as SEC-regulated asset managers. And that 13F, up until a few quarters ago, consisted just of positions that I'd bought for our clients. And since about half a year or so, Andreas has also has his own clients, and so our portfolios tend to be, there's a little bit of overlap, but they tend to be quite different. So it's you can't see from the 13F who bought what, but Paycom was Andreas's investment. So I'll let you respond to that.
Yeah. So it's not an investment in the fund, but I will still elaborate a little bit on it. It's a payroll software company in the US with about 5% market share. The market leader is ADP. And there are a number of smaller companies who are slowly gaining market share, and Paycom is one of them. And they have sold off quite a bit as a result of, let's say, maybe an ill-guided sales strategy. But they are correcting course now, and one could buy the company at a reasonable valuation. We bid below 20 times earnings. It has a high percentage of recurring revenues, and still a low churn rate, even though that moved up a little bit due to the wrong sales strategy. The head of sales also changed. So there's a lot of change, but they're still growing at 10% despite all the challenges. And my bet is a bit that they will reaccelerate the growth when all these changes are being corrected, or all these problems are being corrected. And from that perspective, at PE of 20 and in a non-capital intensive industry, it's a good bet.
Yeah, and then I'll maybe take the question on Pinduoduo. So the company's official name is PDD Holding, and it's a Chinese e-commerce company, which most of you in the room here, at least the non-Chinese people, will know through their international business. Through their international business, which is called Temu, which I hope everyone is an enthusiastic customer of. I certainly am. I think we invested in it just over a year ago or so. I think it's a wonderful business. They've, it's kind of incredible, and it speaks to how dynamic the Chinese internet is. That, in the same way Amazon is very entrenched in the West, you had two very dominant players in China, and Alibaba and JD, and in the same way, it's almost unimaginable today that anyone could disrupt Amazon. I think people had a similar view of Alibaba in particular, but also JD. And really, out of nowhere, Pinduoduo has, become, probably almost as big as Alibaba now, and certainly larger in terms of profitability. And they've really done that through rethinking the business by, in particular, the connecting the manufacturers directly with the customers, so which takes out middlemen, allows them to respond more quickly to demand. They have a very sort of algorithmic feed in the app, which allows them sort of to match products with customers, a bit like TikTok does with short videos. So it's really quite an incredible business, and the share price tends to be buffeted quite a lot by whatever different political winds are blowing in China or in the West, and that would no doubt continue to be the case. But despite all this, the business is growing at 50-60% per year, massively profitable, a very robust balance sheet with tens of billions of cash. So it's a company we feel very confident owning for the longer run.
I may add that the same merchandise is being promoted on Amazon for a much higher price. So you see all these sponsored listings now on the Amazon marketplace, which is essentially the same manufacturers that are selling on Temu at a much lower price. So I don't quite see why one wouldn't order directly there. So I think it has a great future. And of course, it's often criticized for the lacking quality, but I think they're an organization that is quickly adapting and making the right changes to appeal to Western customers.
Thank you. Rob? Oh, sorry. Whoa, this was very loud. Hi. Hey. Let's quickly come back to the question on climate change and IPC. I mean, you already alluded to that the midterm, the demand will be driven, midterm and long term, the demand will be driven quite a lot by emerging economies, which I fully agree, right? By 2050, like every fourth person on the planet will be African. And that means that midterm, that growth will need to be powered by fossil fuels. However, we already see that Africa is leapfrogging many of the developments. Like there's lots of electric trucks on the road, electric vehicles, etc. Also, lots of renewable energies being built out, some countries being heavily reliant on hydropower. And at the same time, we know that I mean, 17 out of the 20 countries like hardest hit by climate change are African. So we will not be able to afford for Africa's development to be completely powered on fossil fuels for the next 50 years. What kind of company does IPC need to be in 2050 for you to still want to have it in your portfolio?
Yeah. Well, to be clear, Andreas and I are both believers that fossil fuels cause climate change, and the sooner the world can get off them, the better. So my expectation or my hope would be that the oil industry is a much smaller one in 50 years than it is today. But even in 50 years, we're going to need oil. There's some things that simply can't be done, or oil and gas, I should say, which simply can't be done in any other way. For example, fertilizers, plastics, and such like. So, I think we're going to need the stuff for a long time. And everything in life is a trade-off. You sometimes see people saying, "Oh, we should stop oil production today," and well, humanity would cease to exist if that were to happen, just because how dependent we are on it. So, I think it's a very ethical investment to support a company producing something that effectively we need to survive, but at the same time we acknowledge climate change and hope the world can reduce its dependency over time. In terms of IPCO as an investment, as Will said earlier on, I think within the next few years they're going to make more cash than their current market cap. So this isn't an investment predicated on a sort of a DCF and a terminal value in 20 years' time. We'll probably earn our money back in the next probably 4 or 5 years, and then whatever they own after that will just be money we make on top. Would you agree with that, Will?
I agree as well. So every investment that we are making is a financial decision, and here the financial decision is that it will take more than just 5 years to get rid of oil, and probably more like 20 years or maybe even more. And in that period of time, there are a few companies where you can earn money. But that's not an assessment of the future of the renewable energies, which I think are going to take over in the long run. So I do believe that electric cars will probably dominate, let's say, the European market long before 2035. So this whole discussion about outlawing combustion engines by 2035 is probably completely unnecessary, because it will happen earlier and it will happen without a law.
I think you already see in China today, well over 50% of new cars are electric. Is that right, Stephen? Of new cars being sold? Yeah. No, so I mean, it's going to happen, but we're going to make a lot of money from international petroleum well before that day arrives.
Thank you very much for this amazing event. And just a quick question. All we know that at the end, companies are made by people. Do you have a process to evaluate management team? Because you said management can also destroy the moat. So I think that management is one of the most important things in a company. And I was wondering if you have a process or some metrics, let's say. Thank you.
Yeah, we think it's incredibly important. And and the astonishing thing is that although I'm sure if you were to speak to Will or any other person who runs a business, it would be it would be so obvious to them it wouldn't even be worth mentioning. And yet, when you sit down in sort of more kind of financial investor circles, they think about moats and DCFs and all this kind of stuff, and people is really an afterthought. So I think we have an advantage in that we pay very close attention to it, not because we're smarter, but just because other people, for reasons I don't understand, don't. And then how do we do it? The way I think about it, like a lot of things in life, you have a sort of a normal distribution of people. So you have, most people are sort of average. Then you have like a small minority of very bad people, and then a small minority of really exceptional people. And really, trying to figure out amongst all the average people which one is a bit above average or below average, that's not the game we play. We're not able to do that. What we could do is notice when someone is really exceptional, because it just knocks you on the head like a sledgehammer. It's just completely obvious. You see it in things like that. Typically, they have made the business they run their life's work. They live and breathe it. they have a large stake in the business. They know all of their employees, or to the extent it's a smaller company, their employees by name. They know their competitors, their suppliers. Everybody know them. So it's really obvious when you find it.
I think every company that we have in the portfolio we kind of admire, and the admiration is basically for the management, not for the company. Sometimes the company is so large that we don't have access to management, but the company itself is a reflection of what the management does and the values that the management holds. So you can clearly admire the management by the company they created.
Yeah, it's interesting because you're always told you should be sort of objective and sort of fact-based or numbers-based, but actually I think sort of admiring someone, like you said, is a very sort of visceral, more of a sort of emotional reaction. But for me, it's a very reliable indicator that you're dealing with good people. Yeah. There's one other person at the front with their hand up, so maybe we can get a microphone here. But next question here.
Hello, can you hear me?
Yeah, we can hear you.
Thank you very much, guys, for organizing this, and thank you, Rob, for completing your trilogy with the Mode Chat last year. I have a question for each of you. Rob, Ernie Garcia, Trading Extraordinaire. How do you position yourself with a stock that within 24 months goes from like 4 to 250? How do you change that, and how do you rebalance? And for you, Andreas, you're famous for a position in bijou, and I'm very curious about jewelry and luxury goods. Can you talk a little bit about the theme of it, the demand in China, and independent producers versus like the larger groups like Richemont and LVMH?
You want to go first?
I didn't get the entire question. I think it was a question on bijou Brigitte, which is not a luxury good. It's a fashion.
Jewelry.
Jewelry.
If I'm not mistaken.
Yeah, even they're selling fashion jewelry. I owned a small position for a couple of years, but I sold now. And
what is the question exactly?
The question was more geared toward that sort of consumer goods and going into the luxury segment.
Yeah, I looked a little bit at the luxury segment, not focused on jewelry, but on different luxury goods. I didn't invest yet. It has sold off quite a bit, but most of the companies have significant exposure to China without this being reflected completely in the valuations. And that made me a bit uneasy. But this can change in the future, and maybe there are some around that don't have so much exposure to China. I'm looking at a few.
Well done for knowing about Andreas's investments from when he was a small kid. Yeah, and then you asked about Carvana, which is it's a marketplace for used cars in the US, which we've been owners of for several years, and it's been an incredible roller coaster. I think the first stake I bought in it was when the share price was quite high, so definitely not my finest moment as an investor. But subsequent to that, I added to it on several occasions when the share price was very low, and those may well have been some of my finest moments as an investor. But in terms of the share price, we try not to pay too much attention to charts. The share price went from 300 or 400 to almost zero at one point, and now it's gone from 4 or 5 all the way back up to 200. So if you just compare the price today with the price of 3 or 4 years ago, you probably say, "Oh, this hasn't really done very much." What we're laser focused on is the business, and there it's just such an exciting opportunity. I think there was a question mark even a year ago about whether this business fundamentally works. Can you sell cars profitably over the internet? The question mark was never, do people love it? I mean, people of course much prefer clicking a mouse and getting a car delivered to their doorstep than going to a dealer and negotiating and being ripped off and all that kind of stuff. So the customers always loved it. The question was whether the unit economics work, and they very, very clearly do. And if anything, I think some of the criticism now is it may be too profitable, which is quite a turnaround compared to where we were a year ago. But their market share is now 1%, and it's such an order of magnitude better customer experience than using sort of offline retailers. There's no reason in the long term why that shouldn't go to, online penetration shouldn't go to, well over 50%, as indeed it has done in other e-commerce verticals. And then the question is, well, if it's going to be such a huge market, are there any other competitors? And, you know, as tough as 2022 was, the big benefit was that because people didn't believe in the business, all of the competitors had funding pooled, exited the market. So it really looks like this could be, you know, something quite close to a monopoly for the foreseeable future. So that combination of a very, very dominant market position in combination with this very low online penetration of the market is very, very exciting. And, you know, the valuation is quite high today compared to what it's going to earn this year or maybe even next year. But you only need to look out sort of 2 or 3 years and all of a sudden it looks very, very cheap. So, you know, it's a company we plan to own for a long time.
Can I follow up actually with book recommendations? Because last year you recommended Bloodlands, which is a tough topic, but a really good read. Any book recommendations this year?
Yeah, I just finished actually over Christmas reading a book on Bretton Woods. I forget the exact name, but the title includes Bretton Woods. So I'm sure you'll find it as one of the first results on Amazon. And it's kind of fascinating, especially seen through the lens of today, because obviously, you know, Bretton Woods, for those of you who aren't familiar with it, was a conference which was held towards the end of the Second World War, where the war wasn't over, but it was kind of clear that the Allies were going to win. So all of the Allied powers, so basically the entire world except Japan and Germany, sort of met in Bretton Woods to discuss what trade and the monetary system should look like in the post-Second World War world. And so you had, you know, these 40 countries come together, a bunch of countries, as you can imagine, obviously UK, US, but also, you know, communist China, USSR. But amongst all of these disparate participants, there was a complete consensus that it was tariffs and protectionism that led to the Great Depression, and it was the Great Depression that led to the Second World War. And as a result of that, they sat down at Bretton Woods and designed a system which encouraged sort of open borders, open trade, as a means to create prosperity, but also to secure the peace. And, you know, seen through today's perspective, it's kind of amazing that, you know, protectionism and tariffs seem to be back in fashion, and everyone thinks that they're going to solve all problems, because the historical record shows actually the opposite. Any books you've read?
What I spent a lot of time on last year was listening to Acquired podcasts. I'm a big fan of them, and they deal with nice companies. Like there is a very good podcast on Meta, on Microsoft, on Deere, on LVMH, and these are two people discussing the business. They are incredibly well prepared, and each podcast lasts for maybe 4 or 5 hours. And it's a great listen in the car or whatever, during sport or whatever. It's get so much information out of them.
I'm a big fan too. Yeah.
So, understand you solved your jurisdiction problem with the fund, and that you will receive some new investors in the fund. I'm just thinking about, how are you planning, or how would you do, say that tomorrow you have an inflow of new cash to the fund that's relatively big. Let's put just big numbers, $200, $500 million of new cash, which would dilute the current investors, no? With new cash, but it's fine. How would you allocate that? Would you think about allocating proportionally to the current companies, look for new opportunities? Like, what effect do you think will have that for current investors, for future investors? Like, I would like to know how you think about this.
Yeah, thank you for the question. So I think the question was, what would I do if there was a huge inflow of cash all of a sudden into the fund? I think the important point to make is that that couldn't happen, because I control whether people can invest or not, and you know, I would for sure not want all of a sudden such a large amount of money to come into the fund and dilute everybody. So I can certainly reassure you that won't happen. But if the question is a sort of a hypothetical one, what would I do if I sort of suddenly had a huge amount of cash? The way I think about it is more like an individual as opposed to sort of a fund manager. You know, imagine, you know, you have a wealthy uncle who sadly passes away and leaves you a bunch of money. I don't think your reaction would be, oh, I better buy all the stocks I own as quickly as possible. I think your reaction would be, oh, this is a lot of money. Let's have a think about what I should do with it. And I think that's the way I would approach it as well. And I wouldn't sort of mechanically buy everything I own. I would think about where my best ideas are. if the money creates opportunities to do things which I potentially previously hadn't been able to do. So I think that's how I'd approach it. What about you?
Well, I can only talk. It's a similar situation with my customers. They gave me money. I didn't invest it all on day one. Just waited as opportunities came along, and I think that's the best approach, to not lose money, not buy something that is maybe not as exciting anymore. And just wait for opportunities, and even if there's a little bit of cash around. I mean, we aim to be fully invested, but that's different from always being fully invested. So aiming for full investment means we look for opportunities and will not deliberately hold some cash. But if we don't find opportunities, obviously we will hold some cash for some time until we find the opportunities.
Normally we find something, but we don't mind if there's a bit of cash in the fund at any moment in time. But it's never a macro call. We don't have an opinion on whether the market's going up or down or whatever. We're just waiting until we find the right opportunity.
Hi, Rob and Andreas. So I have a question on temperament and maintaining emotional stability through volatile times. The last time I was here was 2022, and I think the room, the emotions in the room were quite different than after the very strong year you had this past year, but you both seem pretty much the same. And I'd love to hear how you guys think about managing and regulating your own emotions and how that helps you to make good decisions.
Yeah, maybe I'll take this one and you can chime in, but 2022 was a very tough year, and I don't want to mask that in any way, both in terms of having such a big drawdown in the fund and also having a health emergency. So that was definitely not the most fun year of my life. But as you correctly say, we still I think it was beginning of 2023 would have been the meeting you're referring to, and it was still a great meeting. I thought the atmosphere was good, and everyone was like they are today, happy to be together. So that was incredibly reassuring, and I would say that also sort of leads into the answer about temperament. I think I have a good temperament. I hope I have a good temperament, but whether I do or not, I can't be 100% sure, because what really helps is creating an environment which allows you to remain relatively even-tempered, irrespective of what's happening around you. And I work for many years by myself. And now with Andreas, whereby we're not in the office together every day. We have our own offices. We probably together once or twice a day. So the main contacts I have on a day-to-day basis are my children, Tommy, who's just picked up the microphone, my wife, and that's a great way just to kind of keep a sort of I would say a stable mood, even when sort of the world is sort of tough outside. So for me, that's been incredibly important. And I really learned that lesson actually in 2008 in the financial crisis. So when I started RV Capital in 2006, I didn't have a whole lot of money. And so I worked from home more sort of out of necessity rather than out of any sort of strategic master plan. But it was kind of fascinating. In 2008, when of course the world was sort of falling apart, or seemed to be falling apart, a lot of people sort of really sort of panicked and did really dumb things. And I managed to sort of remain relatively calm. And I think what enabled me to do that was simply just living in a relatively stable environment. My children still went to kindergarten in the morning. We still had lunch together and dinner together. And so, I think creating that sort of stable environment for yourself is incredibly important. And a big part of that is, of course, the investors. If you have hundreds of investors screaming at you and redeeming their capital, then that would for sure negatively impact you. But I'm very fortunate to have investors who were very loyal, very supportive, including in 2022, and I have a big thanks for that.
I think it's always important to focus on facts. When a share price declines a lot, and I saw that with Meta, also with other stocks, all kinds of negative articles come out in the press, which seem to confirm that the decline is justified. But whoever writes these articles is just cherry-picking the part of the picture that supports the way that the stock price is going. So the trick is to either not read these articles at all, or to deliberately ask yourself after every paragraph that you read, what are really the facts that are communicated in that paragraph? Are they irrefutable? Are they clear? Or is this just an opinion based on what the share price has recently done? And it's so important to focus on the facts. If you looked at the data that Meta put out during the decline, the usage of the apps didn't decline. They actually went up, or at least flatlined. So there was no basis in assuming that the company is going to hell in a handbasket. And if necessary, they could have easily cut off the metaverse and the reality labs and restored their former profitability. So, but it all focused on this small segment. All of the press attention focused on that small segment, and it's just important to isolate yourself from it. From an enterprise value perspective, it's maybe influences 5% of the total value of the company, not more. But 80%, what was written on Meta, was focusing on these 5%. And you see that time and again when companies have a big decline. People assume that management can never correct these mistakes that they made, even if they made a mistake, I'm not even sure. And bad times will continue forever. Markets tend to extrapolate recent news forever.
Yeah, whenever there's a share price decline, you can be guaranteed there'll be someone with a negative article about the company. Saw that the last few weeks on Novo Nordisk. It's been probably, for sure, the most successful large company in Europe for many decades, and they had some slightly negative results on one of their GLP-1 studies, and of course, the share price is down, and everyone's talking about how it's no longer a great business, and yeah, you see it the whole time.
Yeah, I have a question around position sizing, and it's more, if you take an investment, do you make it a fixed position, or on the outset, do you decide on a position size, and as the stock moves, especially up, do you add more to it? And the second part of the question is if you like a company for the long term, but something happens in the short term, like to say, that the business climate is going to be challenging for the next 2 years, do you sell some of the position in order to buy it later at a cheaper price? How do you change your sizing around? I know that you have conviction and you like to buy it when it's cheaper. You like more of it when it's cheaper.
Yeah, so I think there's a few questions in there. In terms of sizing, I've really done things the same way since my earliest days of investing. So when I started investing, I had very little money and every now and again a really good idea. And so when I had a good idea, I wanted to really move the needle on my net worth. But I didn't want to risk risk the whole farm. So, what I came out at was back then, if I had a really good idea, I'd probably invest 10, 20, maybe sometimes even 30% of my capital, but never so much that if the bet were to fail that, I'd be sort of bankrupt or anything. And that's pretty much how I still do things today. If something's not worth a 5 or a 10% position at least, then there's no point doing it at all. And it's also a great way to discipline yourself because most companies look attractive through some from one perspective. If it's a great company, well, you might find it attractive if it's a great company. If it's a less great company, it might have a very cheap PE. So it's very easy to sort of end up owning pretty much everything, which is of course the recipe for mediocrity. So forcing yourself to say, okay, if I'm going to buy it, it has to be at least a sort of a 5 or 10% position, I think is a great way of disciplining yourself. And then the second part of the question is, do we sort of, if we think the share price is going to go down, do we sort of sell in order to buy it back more cheaply? The answer to that is no. We'd love to be able to forecast share prices, but unfortunately we can't, so we have to leave that to somebody else.
I may add a few words on rebalancing. So if something goes up in price, you would say, okay, it's become less attractive, so you should sell something. And if something goes down, you should buy it. However, I at least want to add always value with my decisions, and I am humble with regards to the quality of my decision making. So if something goes up 10%, that cannot be that's not a meaningful decision to sell that, because the precision that goes into the decision making is far lower than 10%, give or take. So you can only roughly value a company, and if something moves up 10%, it's still within the, it's just noise, I would say. You cannot really say now this position is earning 15.8% and the other one is earning 15.6, and therefore you switch from the one that is earning 15.6 into the one that is earning 15.8. You should be humble about the quality of decisions that can be made. You don't know the future, so I try only to rebalance or to move from one stock to another if the decision is really a meaningful one. If I'm moving from a prospective, let's say, 13% return into one that is maybe a potential 20% return.
Great. There's one there. Not sure.
No, my question is a little bit going into the direction, also follow-up question on some of the others. I mean, with Trump, we can expect to be some negative impact on the Chinese market because of the tariffs. Are you controlling for that at all, or are you saying, okay, no, we're not acting with politics in mind?
Yes, I think the question was around tariffs and Trump and whether that impacts our thinking about Chinese investments. Is that a good summary?
Exactly.
Yeah, so so much gets written about China, and most of it is sort of negative, and there's so much noise. But there's one really big signal in my view, and that signal is the tariffs and the fact that many Western companies clearly feel they can no longer compete with Chinese companies. And although tariffs in the short term can create noise and maybe impact share prices, I think there's an incredible amount of signal in the fact that Chinese companies have got so good that the Western companies feel their only recourse is tariffs. And I would much rather own the company which everyone is trying to sort of protect themselves from, rather than the ones which are clearly losing the race, but hoping for sort of political help. Because the tariffs won't work. There's a million ways to get around them. Some things you might sort of put tariffs on might negatively impact one of your industries because they're an important supplier. So I don't think it will have any long-term impact. It will for sure impact share prices in the short run. But I think the biggest message to take from the tariffs is just how strong Chinese companies are.
And I would also say that these suggestions of putting up tariffs, I mean, Donald Trump always says he wants to balance the trade deficit and make it go away. But America is a very attractive investment market, and historically, whatever was flowing out of the trade balance came back as an investment into the country, and that the end result was that the dollar is where it is right now. And if you artificially want to get the trade deficit to zero, then you have to make sure that nobody from outside of the world invests in America anymore, or the dollar will move up a lot. Or there is so much contradiction in the policies that were discussed during the election campaign. I'm in no position to say which one of these how these contradictions will be resolved.
Yeah, I mean it's very, very contradictory. I mean, I'm fundamentally an admirer of China, but it is a dictatorship of sorts, with obviously much of the power concentrated with Xi. And that being the case, I don't think that a company like TikTok should be in the effective ownership of the Chinese Communist Party. It's effectively a direct route into the brains of the population of the company that used the app. And yet that's the one decision which Trump seems to be keen to roll back. So there's a lot of contradictoriness, and I don't think that'll go away. But our strategy will just be to try and buy really good companies at attractive prices, and that should work out over time.
So I have a question concerning more like your style of investment, which I find it very interesting because as a value investor, I'm often focused on companies that are cheap, let's say single-digit multiples of some kind of earnings measure. So my question is, you buy companies at valuations sometimes that, let's say, an average value investor would consider expensive or not cheap, at least. And so I think that's a very important signal for how you gain conviction on a stock. And I think that would be my question. How do you go about finding ideas? And what gives you, obviously it's very hard to have one answer on what gives you conviction of. But I would say, what gives you conviction on buying sometimes at double-digit multiples of some measure of earnings or owner's earnings? That would be.
Yeah, so, for maybe the younger people in the audience, sort of the PE is, if you take the price of a company and divide it by what it's going to earn this year, it gives you kind of an indication of whether a company is expensive or not. So if something trades on 30 times earnings, that's a 3% earnings yield, or if it's on 5 times earnings, it's a 20% yield. So it is a useful indicator of whether something provides value or not, but it is a shortcut, and it's a shortcut to finding the fair value of a company. And the fair value of the company is actually made up of the cash that it's going to earn between today and whenever it finishes as a business. And some companies have their cash very front end loaded, like International Petroleum, for example. It's going to earn a lot of cash in relative to its market cap in the coming years. And other companies, it's more back-end loaded. So Carvana, for example, relative to its market cap, is not going to earn very much cash in the next few years relative to its market cap. But we don't mind. We're quite happy to invest in both situations. But the important thing is always that you're buying this cash for less than it's worth, substantially less than it's worth.
Yeah. Just sorry, following up on that, as you, I think, wrote on your 15 years anniversary letter, an integral part of your strategy is having an investor base that supports you in that. But the point is that having call it a forecast on earnings or cash that is coming further in the future is harder, right? So there's been some way of gaining conviction on that it's harder compared to having front-loaded cash. I don't know if I'm explaining myself.
Yeah, I mean, time creates uncertainty, right? So if there was literally a suitcase with $1,000 in it here, and someone offered you for $500, you would know with complete certainty that you're going to make a 100% return. And of course, that situation almost never exists in real life, and so you're always sort of making a bet on the future. There's no way of avoiding that. What I found is the best way to sort of, and of course, the further you go into the future, the more riskier or more uncertain it gets, and actually not necessarily riskier. And the way to solve for that, in my view, is to try and focus on companies where the competitive advantage is increasing over time as opposed to decreasing. If you know a business is getting better and better, then you don't know exactly what the future is going to look like, but you know it's probably going to look better than it does today. And I would argue, for example, with Carvana, that's very much the case. There's all kinds of scale benefits that go into the business. If you think about the logistics, the data from the underwriting, the amount of inventory they have, all these things will, as the business gets bigger, it's going to get better. So although I don't know what exactly Carvana's going to earn in 5 years' time, I'm pretty confident that it's going to be multiples of what it earns today.
Yeah, I may add as to the level of PEs. You always judge corporate profitability on 2 dimensions, basically. One is the sustainability dimension of the earnings power of a business, and the other one is the cash flow quality. The higher the percentage of your earnings that are converted to cash flow, the higher the valuation is that you can pay, and the more sustainable a business is, the longer the expected lifetime of the business is, the higher the valuation you can pay. And if you think back at a company like Coca-Cola, one of Buffett's most famous investments, and you think back to 1930s or so when they IPO'd. Now, what was the company really worth at the time, knowing what we know now? It's a lot, because they never grew very fast, but they grew for a very, very long period of time. And if a company doesn't die, and a good management always finds a way to grow 5% here and 10% there, and does that for 100 years, then a really big company emerges out of that, and a really high value would have existed had we known all that in the 1930s already. Now, by contrast, there are other companies who have to reinvest 100% of their earnings every single year because their return on invested capital is so low. And suddenly, after reinvesting for 20 years, they lose their competitive advantage and basically go from being a profitable growing business, but with zero cash flow, to one that is dying and restructuring, and basically the valuation was always zero. And when the market assigns a low valuation or a low multiple to a company, it's often a judgment about these two dimensions, either the cash flow is lacking or the sustainability of the whole business is in question.
We also, if there's any online questions, happy to take a few online questions. I think Nick is on the case there. So, yep, at the back, I think. Oh, who has the mic? Over there, sorry, yeah. There was also a hand at the back there. Yeah, please go ahead. Yeah.
As investors, we tend to think more of mistakes when things go wrong. But last year you did great, so congratulations first. And I wonder, is there a particular mistake or a learning that you would like to share with us?
Well, I mean, I get things wrong the whole time, as you can imagine. You know, I would say the most disappointing investment I've made is in Ryman Healthcare, which we sold last year. And that was a company which we owned for probably 6 or 7 years and end up selling at a loss. And I can't remember too many times where we've owned something that long and at least not got our money back. And if I think to what went wrong there, it was a company which was incredibly mission focused. So for those of you unfamiliar with it, it's a company that runs old people's homes and villages in New Zealand and Australia. And they did, and in fact, they still do an incredible job of creating a wonderful experience for these old, vulnerable people. But I think over time, the company became so obsessed with its mission that it kind of lost sight of making money, which is an important element for any business. You need to make money in order to reinvest and improve the product and pay suppliers and all that kind of stuff. And I saw the financials deteriorate throughout COVID, but there was so much happening in COVID with lockdowns and real estate transactions effectively having to cease and stuff. So there was always a reason to sort of justify that sort of financial deterioration. But with the benefit of hindsight, it was that the people were just not focused enough on the business side of things. So that's definitely a mistake that haunts me. Yeah.
Well, a mistake on my side I can talk about, it was basically investing too early in a company called HelloFresh from Germany, which I bought, where I bought the initial shares at 17 euros. And I underestimated a bit the dynamic. And maybe there was also a disconnect between the strategy that the management follows and a strategy that I think would be the right one for this business. Management hands out lots of coupons and educates people to cancel their subscription after a couple of boxes, and whereas I think they should just cut prices by 20% and do away with the coupons and all this marketing and promote loyalty among their base. And maybe I kind of misjudged that. Management sent some signals in both directions, but what they really did, and you can see that from quarter to quarter, was basically continue with their old couponing strategies. Now, the business got cheap enough and I still hold it, but I would much prefer them to follow a more sustainable strategy. I think you have to make sure with every investment that you buy that management follows the strategy that you think is the right one for the business.
Hi, both Rob and Andreas, I'm happy to see you again. I have a bit more comfortable question back to Carvana. Earlier this year, there was a short report published by Engelberg Research pointing to the questionable management practices in terms of accounting, some undisclosed related party transactions, and aggressive underwriting practices. I'm curious to know how you think about it, and maybe the second part of the question more broadly, what are your red lines when you look at the related party transactions in terms of integrity of the management assessment?
Yeah.
Thank you.
Yeah, thanks for the question. So we prefer not to discuss short reports per se. You know, the strategy of a short seller is to sort of, you know, highlight all the sort of the negatives and the risks and, you know, things that are potentially going wrong at a company, and that's fine. That's their prerogative. But, you know, effectively, if you start engaging with them, then you're sort of helping them to sort of perpetuate the story they're telling. So, you know, I won't comment on the report per se, but, you know, I've been invested in Carvana for many years now. I've got to know Ernie Garcia, who's the CEO and founder of the business, very well, and you know, can be as sure as you can possibly be, this is the most high-quality individual one of the most high-quality individuals I've met in my life. The idea that he would somehow do something sort of, you know, shady or you know, take money from the company or do something which benefits himself and damages the company is completely absurd. And so, you know, I'm familiar with some of the sort of criticisms out there, but it's not something we pay too much attention to. Who's next?
Hey, Rob, can we just do one from the internet really quick?
Yeah, sure.
There's a number, but effectively, could you spend a little more time talking about how you decide when you're wrong versus, you know, just the emotional side of that?
Yeah. Well, I think what helps actually is, you know, not working in a large team where you've perhaps sort of built, you know, for a long time been saying one thing and then it's sort of maybe psychologically awkward to then have to sort of row that back. You know, I make my investment decisions myself. Andreas makes his decisions himself. You know, of course, we discuss our thoughts on companies and what we like, what we dislike, where we see the risks, the opportunities, but ultimately it's always our own decision. And we also put a lot of our own money, you know, my money is effectively in the fund, so whatever you own is what I own as well. And when that's the case, it's much easier, I would say, to change your mind than in a more sort of corporate environment where maybe there's a disconnect between your sort of financial incentives and your kind of career incentives. So, you know, I hate losing money, as you can imagine, and if I think I've got something wrong, I think I'm normally pretty quick to acknowledge it, and I'm not embarrassed about that. I'd rather, if I've got something wrong, I'd rather find out sooner than later and then move on to something better. Yeah.
It's a tricky question because you should also not be too easily decide that you are wrong. Sometimes I get the impression that I'm wrong. I maybe sell something and in the end it turns out I was always right. So you have to have some conviction in your own thinking. If your thinking was based on facts and you bent over backwards to be as objective as possible when making the decision, then maybe you're not as wrong after all as you may think after the share price goes down. So maybe you should believe in your own judgment.
Yeah, when a share price goes down a lot, it's normally not because of a very sort of clear fact which could be checked and then, you know, found out one way or another. It's normally about some vague sort of risk in the future or risk today, but where the outcome is not clear. So you can never know for sure at that moment in time. You can't know one way or another. And you know, when that comes at the same time as the share price is going down, and then you start focusing on this risk, it can feel like for a time like you kind of got things wrong. But I think you have to sort of trust in the adaptability of the management, that even if they have made a mistake or face a risk, that they're going to find a solution for it, and also the adaptability of the business. And oftentimes, you know, things happen at companies I think very highly of, and you know, I don't know for sure how exactly it's going to play out, But I don't sell because I do sort of trust in the people and the business that they figure it out. And normally that works out quite well, actually. Dennis?
Hey, Robin, Andreas, thanks so much for getting this terrific gathering together year after year. We really appreciate it. I'm not sure that there's a prescriptive answer to this question that I have, but as a bottom-up stock picker, and I think most of us are here, how do you deal with changes in exogenous circumstances? And what I mean by that is 2022 was probably brutal for everybody, except for maybe the energy guys, but you've been waiting for 15 years to be up. But anyways, in a changing cost of capital regime, we're in a fairly benign and stable period right now, relatively. And let's say that here on out, we can expect like a 4.5% 10-year risk-free rate regime. But let's say the impact of tariffs and other inflationary policies lead to a circumstance where rates have to go to 7 or 9. Are there things that you've thought about to maybe avoid the risk of a catastrophic loss like in 2022, like many of us have experienced? Is there things that you have thought about to mitigate those types of circumstances? And what does like a much higher cost of capital regime mean for your portfolio?
Yeah, I mean, there's a few sort of questions in there. And I mean, specifically to 2022, the narrative at the time, and probably even still today, was that all these sort of companies that suffered very greatly was because of sort of increased interest rates and increased inflation expectations. And I've never really bought into that argument, to be honest. I think some of the companies we owned in 2022 are the best companies you could possibly own if you're expecting inflation to take off. They have a lot of pricing power and, capital light. So, I think what happened in 2022, there was a panic, and probably the interest rates were, what triggered that panic. But there wasn't any logical reason, in my view, why, it affected so many of these sort of companies which are now, from today's perspective, have gone from strength to strength. So I would say that's what I would say to sort of 2022. And then in terms of, what would we do differently if we thought interest rates were going to be 10%, in a year's time or whatever, that kind of goes into sort of macro, into something. Fundamentally, we don't think it can be predicted, and even if it could, sometimes you don't really know how it would impact share prices. So given that you don't know, I think the best you can do is buy the best quality business you can at the lowest possible price. And if you knew for certainty that interest rates were going to be so much higher in a year's time, I don't think that would change that formula at all.
Yeah. I may add, interest rates being at 10%, it would likely only happen if we have a lot of inflation. And corporate earnings are kind of inflation-protected assets, since companies can raise prices. So you should rather discount them with the real interest rate rather than the nominal one. So inflation and level of interest rate should not affect the value of businesses too much. Maybe they do, but they don't. Maybe they should affect the price, but not the value.
Hi, Rob. Obviously, you've done really well, and hindsight is a beautiful thing. But are there any lessons you've learned from not owning NVIDIA?
Well, it's a funny story here. So Norman Rentrop is sitting at the front here, and I've become. Norman was a mentor to me, and in the same way he was a mentor to me, I became the mentor to his son. And the way I effectively got to know Richard was that Norman holds this conference in Omaha every year, and the idea is that the price of entry is that everyone has to bring one stock idea. And the particular year where Richard came for the first time, he had this incredibly passionate presentation about a company, and I was like very enthusiastic about his passion, but thought analytically there was plenty of improvement potential. So that was the reason I sort of took him under my wing. But the stock he presented was NVIDIA. So I think that's my biggest NVIDIA lesson is if a talented, smart 17-year-old comes to you saying, no, they're very enthusiastic about a company, just leave them to it.
Yeah, Well, NVIDIA was clearly a mistake of omission with hindsight, but maybe I mean, sometimes you cannot recognize the mode of a business, and what I would say with regards to NVIDIA, they are selling to a few large customers, and whenever that happens, that limits pricing power. And that's true today as it ever was, just it has been temporarily put out of effect because of the supply situation for AI chips and sudden spike in demand. But I'm not sure if longer term the economics will not dominate the business. You have basically 3 big customers, and each of these 3 big customers have their own silicon programs where they produce their own chips and will do everything to avoid paying so many billions of dollars to NVIDIA in the long run. So.
Yeah, I think NVIDIA is not one that we would lose sleep over. I don't think we saw it coming, and there's no reason even, why we should have done. I mean, it's way beyond our circle of competence. I mean, I think it's things more like maybe Apple, when it was clear how dominant the iPhone was and how cheap the stock was. I think that was well within our circle of competence to recognize things like that. So that's probably more where I would lose sleep over. Yeah.
Well, ideally, you want a company that has lots of small customers, not a few big customers.
Yeah, for sure.
Hey, Robin. Hey, Andreas. I believe both of you hold positions in Meta, are still holding them, and I'm just curious, in an update, do you think their competitive advantage is growing, and what do you think about the management? Is it moving in the right direction?
Yeah, I mean, we're huge admirers of Mark Zuckerberg. I found it stressful to be a Meta shareholder for most of the last, well, actually ever since I've owned it. The share price was always going up and down, and there was all this sort of criticisms about the company. Whenever something went wrong in society, it was always supposedly Meta's fault. And I found that stressful. And I was just like a sort of an anonymous shareholder sitting in my office. So I just don't know where he gets the strength to sort of keep on plowing on despite all the kind of the stuff that gets written and talked about him. And financially, clearly, he doesn't need it. So he's someone that's clearly very, very, motivated by the task at hand as opposed to anything else. And so we're huge admirers of what he's doing. Yeah.
I can only second that. Mark Zuckerberg is a really great manager. He has always adapted Meta to all the challenges that came up, and has done a really great job there. And maybe the one mistake he did, he was too quick at admitting guilt when somebody was throwing some allegation at them. But here he seems to have corrected course. And in terms of the valuation, the stock is not very highly valuated, especially when you take out the losses of the metaverse division. They may be trading at a PE of 20 or so, maybe 21. And I would think that we should really take out the losses of the metaverse decision, since either they succeed, then we're all happy, or they don't succeed, then after 5 years or so, these losses will come to an end. So losses never have the same sustainability dimension as earnings, positive earnings, to judge it in the sustainability dimension.
Would you say the moat is getting wider or narrower?
I would say it's getting wider since it's based on more platforms. Just 10 years ago, it was just a blue app, and then they added Instagram, and they added WhatsApp, and they are connecting those. So I think there is something in it for everyone.
And it seems to uniquely benefit from AI.
Absolutely, yeah.
It seems, I'd say it's widening as well. Yeah.
Could you discuss how your fund is structured from a legal perspective in Switzerland, and what your dealings have been with FINMA, etc.? Sorry for the boring question.
Yeah, so we have a slightly, so we are regulated in Switzerland by FINMA. Up until 2 years ago, we could do what we do unregulated, which with hindsight was a paradisical state, but unfortunately we were thrown out of paradise. No, so we've been regulated for the last 2 years. I think it's had some positive impacts. So by far the most positive one for me. I was working on my own until we were regulated, and really in response to being regulated, it was clear we had much better chance of getting a license if we were 2 people rather than 1, and so really for that sort of regulatory sort of motivation, Andreas and I got together, but it's something we probably should have done years before, and which we both enjoy, and that's been incredibly positive, and for that reason alone, it was probably worth it. But it also there's a lot of box ticking involved. You have to sort of just create this sort of document trail of stuff which doesn't seem to be particularly relevant to the risk the customer takes, and they check whether you've kind of completed the documentation, not whether you're actually sort of avoiding the risk they're trying to prevent. So that stuff is quite tedious and probably going to increase over time. But you hear that in all kinds of sectors, not just our one. I mean, I do think regulation is a real problem of our times, because whenever something goes wrong, there's this big sort of public outcry, and people understandably want something to be done. And so it normally ends up with regulation. But no one sort of thinks of, what are the trade-offs? Does the additional cost of regulation potentially create a worse outcome than in the world before you had the regulation? Because, in reality, you can never have a perfect state. There's always going to be one thing go wrong. And unfortunately, people don't seem to have that great appreciation for trade-offs. Yeah.
I don't have much to add. I would say we are complementing. We are quite complementary persons. Rob has different strengths than I have, and I have different ones than he has. So we work together very well in terms of mastering all these challenges. And with regards to regulation, I think RV Capital has gotten a better organization in certain terms. In other terms, I think the regulation doesn't prevent many risks, but you can never make a regulation that is the right for every company. So you always have to make a set of rules that try to make the system more stable. And this set of rules may be the wrong set of rules for one company, or let's say not the wrong set of rules, but some of the rules may only apply to this one company, but still you have to follow all of them. So, but overall, I think it's still reasonable, and we're not too much distracted from investing.
Hi, Rob. What would you say the 2 to 3 back here? What would you say the 2 to 3 characteristics that exceptional managers have that set them apart that are so obvious? You mentioned that exceptional people are a lot easier to spot, but what would you say the key things that they do that are so great are, and what advice would you give to CEOs on what the key areas to focus on are?
Yeah, so I understand the question, but I slightly disagree with the premise. So I think sort of great managers and great businesses sort of grow up together, and the business is often a reflection of the manager, and the manager is a reflection of the business. So the idea that there's sort of certain traits you can sort of transplant to someone and then send them into a business and go and do it, I think that's very, very tough. That's not something I think I would be able to spot or judge. For us, the sweet spot is when you find a sort of someone who's building a business their life's work, so you have this sort of 20, 30-year track record where you can see what they've done, the values they have, how they've infused them into the business. And when you see that, it's sort of very, very obvious. But I would struggle to say there's sort of any sort of particular traits that you would necessarily look for. I mean, and you see that in reality. You have some managers like Steve Jobs, who, from what I understand, was a very difficult, almost unkind person to work with, but obviously built this incredible company in Apple. And then you have people with the exact opposite traits of being incredibly sort of kind and compassionate, and they also build great companies. So I don't think you can sort of reduce it to sort of traits per se. It's always goes hand in hand with the business.
Yeah, I agree. There's nothing in particular we look at.
Hi guys, thanks for having us here this weekend. My question was around how you prioritize your time, whether that's quietly reading in the office or talking with other investors, going to see companies, and if over time, how you value those buckets, has that changed at all?
Yeah, so for me, the part of the job which I enjoy the most is actually going out and meeting with the people that run the businesses and hearing from them about how they built the business. You know, a conversation like you heard me have with Will earlier on today, that's for me the highlight. But of course, you can only have that type of conversation if you've done your homework beforehand, and you know, no CEO was going to make time to speak with you if you know they're going to have to start right at the beginning to explain stuff. So. Yeah, I would say the visits are the most important and most value-added part, but there's a lot of time spent in the office before that, sort of learning about the companies, trying to figure out which ones are worth visiting, which ones aren't worth visiting, and yeah, I would say those are the two buckets. And that was, you know, like, without wishing to sort of defend the track record of 2022, but a big part of how I invest has always been going out and visiting the companies, you know, kicking the tires, looking at the CEO in the eye, and just meeting Daryl's eye here. And of course, that was impossible in 2020 and 2021. And so I felt, you know, there were things I potentially might have sold at the end of 2021, but where there was maybe I didn't have sufficient confidence that I'd sort of really sort of crossed the T's and dotted the I's on other things I was looking at.
Yeah, where we are, I think, both not spending a lot of time on discussing with other investors. I think we are spending more time on the companies and reading about them and setting up calls with them. And but talking too much to other investors, I think, is a potential cause of bias. You may have this investor in high regard and he likes a business, and then you think, okay, if this investor is a great investor and he likes the business, then maybe you should like it too. But you should always look at the facts and start from zero and build up your conviction about the business from zero, and not be influenced what other people think about it.
Yeah, I probably speak a little bit more than you do with other investors, although for me too, it's not too big a part. But in particular in China, many investors I enjoyed talking to, several of them are in the room here today, and that's been an incredible, yeah, I'm very grateful for them for the time they take to explain businesses to me, and I certainly wouldn't have got to the level of knowledge I have today without those conversations. But that being said, at some point you have to buy a company, and when you buy a company, typically things go wrong at some point, and if you haven't sort of built your own inner conviction, you're likely going to panic when things go wrong. So ultimately, you always have to have your own conviction, and it can't be based on what other people have told you.
My question was about, you talked a lot about people and the inner conviction, and we met many of the CEOs you invest personally in. Might that not also create kind of a problem? You become too attached to the company, and it might create kind of a hurdle to then sell the company, because you know the people behind the company, you know they're maybe good-hearted, but maybe the company is shifting in the wrong direction. How do you kind of detach, or how do you handle that potential risk?
Yeah, it's a great question, and of course, you know, if you have a close relationship with the CEO, then you're inevitably going to be less inclined to sell it, because it potentially harm that relationship, or you know, disappoint the CEO or whatever. So I would say that's definitely a factor, but you know, everything is always a trade-off in life, and if that's the downside, you know, what are the upsides of having a great relationship with the CEO? You're going to know the company a lot better. You're going to enjoy being invested with that company a lot more, which will make you more motivated to sort of visit it and study it carefully. And I think it will also, to the extent your own values are good and you sort of align yourself with CEOs you admire, it will be a great indicator of whether that CEO is a good one or not. So there are for sure some downsides, but I would say the upsides massively outweigh them.
I agree, and I tend to give CEOs the benefit of the doubt if they do something that I don't completely understand, maybe, or that I instinctively am critical about. But if I think of my Meta investment, when they acquired Instagram, they were criticized for acquiring a business with no revenues and for $1.3 billion, having only, I think, 50 employees and no revenues. And when they spent 20 billion on WhatsApp, they were again criticized. And the same was true for when Google acquired YouTube for 2.6 billion, I believe, and no revenues, no. And your instinct is when a company does such a move, you don't completely understand it, and your instinct is to say, okay, I would never have bought that if that was a standalone business. But then again, you admire the CEO for what he has built, and he's done a great job there. And I think in this case, you should trust that he is doing the right thing, even if there are sometimes decisions that you cannot from day one understand.
Hello, Rob. Andreas. Thank you for having us. My question is regarding the Norway-based corporation income tax, which is north of 75%, I believe. So why you invested in Aker BP, like specifically based in Norway, considering there are many other oil and gas companies worldwide which are very right valuation? And your thoughts on Occidental Petroleum, if you have researched. Thank you.
Yeah, so the question was about the sort of the tax situation in Norway. And so the taxes are very high in Norway, I think 75 or even 80%. But that's not really too relevant to the investment decision because you price that into the price you pay. So effectively in Norway you have an 80% shareholder in the company, which is the government, and that's totally okay. And the question is more around the sort of the stability of the tax regime, because you don't want to think you've got an 80% shareholder who suddenly becomes like an 85% shareholder or something, and with the equivalent loss to your stake. So the stability is much more important than the absolute level, because you could just price the absolute level in. But actually, while we're on the subject of Norway, it's actually an incredibly favorable tax regime which greatly incentivizes investment. So they have this system. They were, especially in COVID, they were very keen to encourage investment. So they have this system that, obviously, when you start to develop an oil field, you have a lot of cost and no revenue. And then, in most regimes, when you start to make money, you can use those tax losses to reduce your tax. Whereas in Norway, you get a cash refund for those tax losses from day one, which obviously de-risks projects massively. So it's actually, I would say, the tax regime in Norway is a big factor in favor. And actually, that's like a great sort of anecdote about Aker BP is, so when COVID hit and the oil industry looked like it was going to shut down, the Norwegian government created these sort of tax incentives to encourage investment. And Aker BP had a lot of sort of projects that it sort of had in its pipeline, and it went all in to sanction those projects and benefit from these sort of tax subsidies, whereas other companies which are sort of maybe didn't have the backup of strong shareholders, more maybe focused on cash flow, weren't as aggressive in investing, and that's what we love to see. And Occidental, I don't have an opinion.
Thank you.
Well, I agree. I mean, these taxes that are charged in Norway are a variable expense. You are more concerned about fixed expenses, and we value the 20% that we own and not the 80% that the government owns. And as you described, CapEx is immediately tax deductible, and therefore it's not so bad as it looks at first sight, maybe.
Thank you.
Hello, everyone. I'm Francesca Preda from Sorrento Cos, Italy. Thanks for taking my question. To be here is a big honor. My question regarding how to become a better investor. If Robert and Andrea have a time machine and could back in the time and to meet a little Robert and Andrea, which advice will give to him how to become a better investor, which we dance a part to follow? Thank you.
Yeah, I like the question. I don't think there's any shortcuts, though. I mean, obviously, you could go back in time and tell yourself to, if I could sort of speak to myself of 20 years ago and could just give one piece of advice, it'd probably be, buy software. I mean, software has just been... but unfortunately, you don't have a time machine. And I do think the way you learn investing and become a better investor is actually experience markets and what they do to your psychology. You know, you have to have been through a few big downturns to understand, you know, what happens. You know, in hindsight, it always looks super easy. You know, when everything was at rock bottom in 2009 in the financial crisis, and you know, great companies trading on 5 times earnings, and it kind of looks simple. Just you know, I would have bought them if I was in that situation. I can imagine a lot of people think, but in practice, when prices get that low, there's some very genuine concerns in the world and risks, and so it's much harder than it looks, primarily from a psychological perspective, I would say. So, and the only way to learn that is just to invest through time. So I don't think there's any sort of shortcuts that you could take. But my advice would just be to just study as many industries as you can, study them over time, because how they develop over time is actually more important than at any moment in time. And the great thing is there's always a new company you can look at, a new industry. So it's something you can continue doing your entire lifetime.
My advice to Andreas would be trust in your own judgment. Because I have a tendency I had a tendency some 20 years ago to listen too much to others. I instinctively thought software was a great industry and worthwhile to invest in, and then I listened to people who said, no, it's too short-lived and yeah, too expensive, and yeah, it's technology and you shouldn't invest in technology and things like that, which deep inside me was never very convincing, but I convinced myself, oh, these are much more knowledgeable people than I am, much more experienced people than I am. Maybe I should take their judgment more seriously. And that was a mistake. I should have just followed my own thinking and trust in it. Yeah.
Rob, time for one more.
Okay, one last question. We're just
I don't know,
past the hour. I know everyone's
I don't
keen to
know
get
who
to
this
the
is directed to, but first of all, thanks very much for having us.
Yes.
I just would like a little bit of color to the investment in Deere & Co., please.
Okay, that's Andreas's investment, so what?
John Deere. John Deere, yes. Okay. Well, on the surface, it sounds like a very boring company. It was founded in 1871. And so it's 150 years old or so. And normally you would think a company that old and that big will grow very slowly, have not great returns on invested capital since they are dealing with large and expensive machinery and lots of metal and so on. But when you look at the numbers, you see a completely different picture. It's an asset-light business. If you take out the financial part, it's a fast-growing or reasonably fast-growing business. It's totally dominant in its industry. Great return on invested capital, great cash flow dynamics. Management is top-notch. They've had, I think, only 9 or 10 CEOs since it was founded. They take a very long-term view. They started investing in software and AI and GPS technologies 20 years ago, long before everyone else in the industry, and they are now the market leader in precision farming and able to monetize some of the value that they create for the farmers. For farmers, fertilizer, for instance, is a big expense, and if they manage to cut back the use of fertilizer a little bit because there's less overlap in the track that the tractor or the combine goes over the field, then that's a real monetary benefit, and John Deere can monetize some of that. And now competition is just now trying to catch up by cooperating with Trimble but John Deere has done that for many years, and they basically go for the same kind of engineers, for the same software engineers that Apple and Google go for, and they have their own development centers in Silicon Valley, and people work for them, even though they pay a little bit less maybe than Google or Apple, but because they're not working on a slightly better placement of the ad, improving the ad placement maybe by 0.1%, and that's basically a success when you look back over your last year. Then you can claim you improved the ad placement a little bit versus you helped making a hard job which the farmer does a little bit more easy. You have a tangible product that you created and you helped feeding the world. So that's a great pitch, and people are loyal, yeah, it's a great culture.
Yeah, what's impressed me about it is the way sort of technology is really a tailwind to the business. So we saw this video where they even have little lasers on the tractors which can shoot the bugs. So which obviously saves you using sort of poisons and that kind of stuff. So yeah, it's an impressive case. Well, difficult to believe, but we're already past 12 o'clock and the mountain is waiting us. So just before everybody leaves, a quick reminder. So we have an aperitif followed by dinner in this room here from 6 p.m. onwards. You're all welcome. Also, if you have partners traveling with you, feel free to bring those along. And yeah, enjoy the afternoon, whether it be skiing or hiking.
Yeah, and maybe a few words regarding the hike. So we will start at 12:45 from the Hotel Terrace. And whoever lives somewhere in some other hotel can come to the base station of the Bruni lift at about 1:15. And please buy your ticket in advance online on the Bruni lift website. Pardon? I did already. So the link is in my WhatsApp group.